I'm doing a top-down analysis. Started with the weekly, then I went to the 4-hour. After the 4-hour, I went to the 1-hour and 30-minute chart. Still a bunch of mess. Still a bunch of mess. Let's talk about money. This is 30-minute right here. Looking at my plans against the 30-minute. 670 entry. 672.4. I like that. Alarm going at 671.5. For the call. Again, using a larger time frame for the put. I'm saying 667. It's not going to be sufficient. Change that. 666 entry. So yes, I'm changing that. 668 strike, 666. 666, 1 for the entry. $663.5 for the first profit target. $659. Say 660. $659. 2. There we go. So I'm going to set this alarm. At 666.5. See how that lines up. That's the 30-minute. Let's see what that looks like on the 15-minute. Good morning, Todd. Shout out to you. Yes, I like it. I like it a lot. Bears now have control of the week. When the market opens, however, the Bulls will have regained control. When the market opens, the Bulls will have regained control. Cleaning up my computer. For some reason, my computer likes to open up a whole lot of Google pages, and that slows my computer down. What you looking at, Todd? You got a plan? Dr. JB, good morning. What do you think about what's going on, Dr. JB? I'd love to hear from you. Todd, what you looking at this morning, Todd? Nkosi, good morning. What you thinking about this morning, Nkosi? What are you thinking? I'll show you guys my plans for today. Slight gap up on the market, but to be honest, I'm looking to short a pop. This is my plans for today. I like to get a call at the 670 strike area. An entry is 672.4. Take it to 670.52, then possibly 677. Again, 670 strike, 672.4 entry, 677.2 ultimate profit target. Taking some profit at 675.2 along the way. If the market decides to come down, then I'll be looking at a 688 strike, 666.10 for an entry, 663.5 first profit target, 659.2 second profit target. So I need to extend this just a little bit. There we go. That is what I would like to see. In order for me to get involved today, a call above 672.4. As we are in this controlled selling algo, I will be looking to break the algo to go long. It's just that simple. If we break the controlled selling algo, then I will go long. If we continue in this controlled selling algo, then I will go short and looking for that at a 668 strike, 666.10 for an entry, taking it down to 663.5 and then 659.2. Let me show you what that looks like on the Think or Swim chart and why I like it. For me to show you that, I want to go to a larger time frame. Let's pull up this 30-minute. On this 30-minute chart, that's 672 that I would like to enter a call. Coincidentally, will be above yesterday's high. A break of yesterday's high is what I am entertaining, possibly for a call. A break of yesterday's high. Continuing, if the market decides it wants to come down, taking that 666.10 entry, will be continuing past yesterday's low. Again, looking for a potential trade with a break of yesterday's high or a continuation down from yesterday's low. Nothing in the middle. And this that I'm looking at, and I created my plan today off of the larger time frame charts. I said, I ain't looking at nothing much, just waiting for the class. Definitely, brother, it's definitely coming, man. I'm so excited. And I plan to start posting the dates next week. So please stand tuned for that. And Kosi said he's looking at a 671.1 call. Let me see, what was I at? Okay. I actually have my alarm at 671.5. So I'm with you on that. 655 put. Break and retest 655 put. It might be a typo. It might mean 665 put. Break and retest. Got you on that. Big Ben in the morning. Grateful day to you. Shout out to your teammate. So thankful for you guys in the building. Let's do what we do best, guys. Let's do what we do best. Look for clear opportunities. Look for obvious trades. Finish this week up strong. We do not have to trade, but we do have to follow our rules. Following our rules is what makes us money. Thank everybody for tuning in and watching the replay of some real change. Stock options trading journey. Here with me are several wonderful traders. And I'm grateful for them sharing their journey that we all may benefit as well. Patience pays. Discipline is the key. Discipline is the key to consistency. Only thing we have to do now is just hurry up and wait. A little more than 3 minutes on the clock as we come into today. Got a couple competing algos. As we know, the Bears do have control of the week. But when the market opens, the Bulls will have it. But for how long? That is the question. See if I can show you these two competing algos as Jesse Swanson checks in. All right, thank you. And Coach, he said 665.5 on that put. I'm with you on that. I would like to possibly get it just a little bit earlier, but I'm definitely with you on that. Looking for a break of that monthly support. Two very real competing algos. Let me show them to you. Number one starting in this control buying algo started at 4 o'clock this morning with a double bottom and a lower high, a double bottom and a higher low, putting in a 662.7 bottom, and then ascending all the way to 671.2. A very beautiful controlled buying algo that we're in. But if you want to see that controlled selling algo that is much larger, we got to go to the 30-minute chart. And there she is on the 30-minute chart, coming all the way back until really Tuesday. If you want to go back to Tuesday, so we put in our high of 683.4, and since then we've put in a lower high, lower low, lower high, lower low, lower high, lower low. Even the bounce this morning is a lower high. So I am possibly looking to short back down. If we take a call, as I showed you on the trading view chart, that ultimate controlled selling algo that we're in, I'm now showing it to you on the Think of Swim chart as well. Respect the algos. The market is in a controlled selling, but even that controlled buying that we had is still within the controlled selling algo, and we have not broken out of it as of yet. So it must be respected. As just like before, as the market got to the top of the algo, the bears stepped back in, which is why I want to wait until we get above that 671, preferably the 672, breaking this control selling algo, continuing in this control buying algo. Unless that happens, will we break the selling and continue in the buying, I'm not getting in. That area is going to be above 671.50. I'm just choosing to get above in at 672 because there is clear still resistance here at the 672.4. If we get over that resistance, then I will join these bulls in this. But other than that, this could be a very trap by the bears. This could absolutely be a trap by the bears, creating this liquidity to take the market down lower, just as it did yesterday. Creating that morning liquidity, that morning buying algo. Just let me watch what I tell you. I'm going to take this and I'm going to hit the word duplicate. I'm going to grab this same algo and then I'm going to slide it over to yesterday's action so you can see the exact same thing took place yesterday. That beautiful control buying algo only to be used as liquidity to take the market lower. Don't be fooled. And just like yesterday, we were looking for a strong break of that algo, and it did not happen. Going to be extra patient today. Extra patient today. Let's take it on home. Let's get it on a Friday. Yes, sir. Jared Lewis in the building. The team is here. The patience is here. Let's do what we do best, team. Since the market has opened, I can show you that imprint what we just had, that control buying algo pre-market that I was telling you about, and all it did was go right to the top of the algo. So I'm looking for a break of that in order to get into a put. If we flip from green to red and continue, then I'm looking to get in a put at the 666 area. Alarms are set. If the alarm goes off, the market will get my attention, and then I will be patient and then see what takes place from there. Whoa. Beautiful red to green move. Beautiful red to green move. And that's exactly why we wait, and that's exactly why we are patient. Just for a note, team, because of this very strong bullish action and this red to green move where the bulls came in and rejected lower prices of the 668.9, if the market breaks that 668.9, those bulls have to cover. So look out for that potentially. First 5 minutes very volatile. First 15 minutes can trick you. Have you thinking the market's going one way and then completely go in a different direction. Give the market some time. Let it show you what it wants to show you. Starting to get to the good stuff, I tell you that. Starting to get to the good stuff. Is it sustainable? As the market approaches my first alarm. We have broken outside of the algo. We have broken outside of the algo. For those of you who want to get in early, give yourself just one more minute. And the 15-minute chart will be upon you. New 15-minute chart is upon us. Nicosi said waiting on the retest. It's now my area of interest, waiting to see if we turn this resistance into support. If so, I'm in the call. And that's exactly why I chose the 672.4 as my area that I want to see us turn. I told you there's a clear line of resistance here at 672.4. I want to see us turn that into support. And then we have a very clear directional move towards the upside. Other than that, we could absolutely be shorting a pop up here. This is when discipline hurts. Because he said, yes, sir. Potential beautiful 3-candle reversal on the horizon. Looking at the 2-minute chart. Potential beautiful 3-candle reversal on the horizon. There she is. Beautiful 3-candle reversal on the horizon. Two beautiful scalps. A nice call scalp and a nice put scalp. 671.4 entry in Kosi is saying. I believe that's on a call. Please be careful, sir. Team, you also want to look at the higher time frames as well. The 15-minute chart is showing us a possible 3-candle reversal, especially with this second candle being a hangman. If the market gets below 670.7, she's out of here. Let me put an alarm there. A lot of bulls stepped in at the 670.7. If she gets below that, those bulls are trapped. She came right to it and bounced. Look at that. Right to that line and bounced right to that alarm line. She gets below that 670.7 where I just put alarm. She gets below that, she's out of here. She's out of here. Those bulls would be forced to cover. This also would be a lower high. I repeat, this is a lower high. Be very, very careful if you are in a call right now. This is a lower high. The bears are holding on. It's time to go to level 2. It's time to go to level 2. Let's see what the deal is. Big orders on the buy side. Big orders on the sell side. The bulls are putting a line in the sand at the 670.66. The bears just overtook it. Those bulls will now start covering that I just told you about. Unless they come back in very, very aggressively. Less than 2 minutes on the current time candles. In less than 2 minutes, we'll get a new 30-minute candle and a new 15-minute candle, respectfully. The bulls now have a line at the 670.80. The bears have been pushed back up to the 670.90. Hard fought battle. Big orders coming in on both sides of the market right now. This is a tug of war, and that's why we're at level 2 right now. The bears just brought their line down to the 670.70. The bears just moved their line down to the 670.70. The bulls are in trouble. But some big orders just came through on the bid. Huge orders just came through. What difference will they make? We'll determine here in the next 15 seconds. The bulls are stampeding. All those orders that just came through, those bulls are now running. to cover. The bulls line with big orders at the 670.50. The bulls are holding 670.50 as we come into a new candle. This is going to be a very important candle as the market attempts to retest the 671. If the bulls cannot reclaim the 671, they are in trouble. And they just did reclaim the 671. The bears just put a line at the 671. The bears put a line at the 671. Just back the bulls down to the 677 area. The bears are backing the bulls back down. The line now is at 678 area on the ask. The bid, the bulls are at the 670.65. They're trying to hold the 65. They don't want to see that 65 crack. The 65 just cracked. Here they come back now. Man, I love level 2. Pure price action. This is a very serious candle. This is a very serious candle as the bulls just took another hit. The bears just moved it down and got below that 6. I told you if we got below that 676, they just flipped the candle. This candle went from green to red. If the bears get it to 670, she's out of here. 670 is a monthly area of support. That is where the bulls will have to find some strength and defend the 670 area. If the bulls do not defend the 670 area, good night, Irene. We're at the 670 area. What are the bulls going to do? Oh my goodness, they're giving up the juices. They're giving up the juices. They're giving up the juices. The juice is loose. The juice is loose. The juice is loose. Now, team, I gotta be completely transparent. Like, if you not notice, I'm really smiling, like, real heavy. And I have to tell you why. Okay. I know that certain trades that I call out, people follow me in those trades. And the worst thing I would ever want on my conscience is that someone follow me in a trade and did not make any money. So when I make my plans, I'm looking for the obvious trades that we all can make money off of. I'm not just thinking about myself. I want to put us in a nice, comfortable position where we all can make money. But lately, I have been scalping my butt off, taking advantage of opportunities that present themselves. I caught the call and both put scalps. So I'm very ecstatic right now. But I'm not going nowhere. I'm not leaving the team. I'm still staying true to my playbook plans, and we'll take those trades if and when they present themselves. But some of these scalps, this call scalp happened so fast. This put with this rejection, knowing that I was talking about we could probably short a lower high. The same thing happened here. So I was able to catch this call, this put scalp, and then the 955 put scalp off the lower high. Looking at the daily candle off here to the right, looking at the daily candle is being threatened right now, potentially going from green to red. That will additionally be another put scalp if we flip from green to red. If we flip from green to red. Yes, sir, Ben. I got that from you, Ben. Taking the money when it presents itself. But I will show you guys right here on the 2-minute chart exactly what my trades were. For reference purposes. Oh my goodness. There she goes again, potentially. Well, I'll come back to that. We still have live action right now. There's still more money to get. We're going from green to red on the daily chart. There's more money to get. Waiting for a close. Waiting for a close below this area of support. And then a continuation candle. Let's pull up that 30-minute so you can see very clearly. Looking for trading beneath that 668. 668.9. Trading beneath the 668.9 will put these last bulls in a position, forcing them to cover. Creating a beautiful shooting star right out of the gate on the 30-minute chart, looking at the larger time frame, looking for confirmation that's going to be below the 668.9. This is where we start getting into the easy money. Keep it in mind, let me show you on the 2-minute chart why you have to wait below that is because we're now at the bottom of that control buying algo. Look at that, team. Look where we are right here, team. I'm going to highlight it, which is why I didn't jump the gun on that. Because all we did was just come down to the bottom of this controlled buying algo. We went up, put in a higher high, okay, but right there at that 672.2. Remember I told you I want to take a call above that 672.2. Saw the opportunity here, took a quick scalp. Saw the other opportunity as I called out a beautiful 3-candle reversal with the hangman in the middle. Then called out another put as I told you we were making a lower high. Okay? Now, we have broken below the support. We got to close below it, but now we're looking for continuation. That continuation will have us breaking this control algo and also going red for the day on the daily chart. There's a lot going on right now. We just have to hurry up and be patient. And Kosi says, when I get in, I set a stop just below previous candle or in an area where I know I don't want to be in the trade. Very smart, very wise. And here she goes right now. Remaining patient just a little bit longer. Don't want to get caught into this trap. But we are now heading down. We are now heading down. The bulls are putting up a fight. Still want to allow this candle to close. As we have this circled here on the 5-minute, we're right at the algo. Looking for a continuation move down. Let us get a candle close so we don't get tricked and pulled right back into it. As the bulls sometimes do sweep in areas like this, this is a liquidity sweep area as well. So it would not be surprising if bulls came back in at the bottom of the algo at this liquidity sweep and took the market back up. What we're waiting on is, there we go. This might be what we're waiting on right here. Being patient. That's why we have to wait. We got the confirmation, looking for that continuation. We got the break outside of the algo. That's confirmation. The market now making a new low will be continuation. Here on the 2-minute, you can see those trades very clearly. Here at the 940 candle, that beautiful call going right up into the 672. Here on the 948 candle, you can see that beautiful 3-candle reversal with the hangman in the middle. Bam, bam, bam. Once we started reversing, got out. Then you can see the lower high very clearly here at the lower high, appearing almost as an evening star pattern confirmation below that 671.4. Did not catch this, however. Okay, thank you, Jesse. Jesse said, I got out on that. Should have upped my stop and let it keep going, but you still got to the bank, Jesse. Congratulations on that. Beautiful work on that, Jesse. Yes, sir. Have a great day at work. I share those sentiments as well. Putting the 2-minute back where it goes. Again, we're back to referring to the larger time frames. Looking at the 15 and looking at the 30. The 30 is showing you where we want to go. So if you want to get that confirmation, you need to wait really just a few more seconds, because now we will have another 15-minute candle. The next 15-minute candle that breaks below that 668.8 could be exactly what you're looking for this move down. We've got the confirmation on the 15, looking for continuation right now, potentially. And there it is. On the horizon. Let's see if she shows up. She is. She's showing up. We've read for the day also. Is anybody in this trade? Yeah. Definitely look forward to that. We'll be looking forward to that, putting together another meetup this year as the weather changes. We'll be looking for a beautiful city to come to. So I'm very interested. And a meetup where we all could get together and trade in person, make some money, and then go out and have a really nice meal together. My long-term plans have not changed, even though I did do quite a bit of scalping. Very plain and simple to see. Looking for that 672.4 break. We got up to it, close to it, but we did not continue through there. Found a great scalp opportunity to the downside that we was able to take advantage of. Convincingly, will have been a great opportunity for a put once we get below that 667.5 area as we closely approach it. So if you're waiting for those larger areas, fine. If you did not get on this scalp, this put that I just called out now, that's fine as well. As I walk the team through it on the 30-minute, walk the team through it on the 15-minute with the confirmation and continuation. And then I asked, is anybody in this trade? I always do my best and share what I see with the team. But it's always best for you to trade based upon your level of understanding. And that is what is taking place right now. Nobody got in that, huh? All righty. A beautiful 5-minute scalp if you're in it. Respectfully, take some at the end of the 5-minute candle, please, and thank you. You got about another minute and a half to get money off of this candle if you're currently in it. That just very well could do a retest. So if you are in this scalp, respect it. Take this money here within the next 1 minute and 20 seconds. Get as much as you can. One minute of money left on this beautiful 5-minute candle scalp that I called out yet again for the team. You got 1 minute left to get money on this trade. Right here at the 667.6 area, I will start trying to take profit right now. At the 667.6 area, start taking some profit now. As we got 45 seconds left on this beautiful 5-minute opportunity, I would have started taking profits already at the 667.6. And you can see why here on the 2-minute chart, why I said start taking profits there as the candle is pulling back slightly as we get towards the close of this 5-minute candle. You can see the pullback slightly on the 2-minute candle. For those of you that are remaining patient for that put that I called out, shout out to you and thank you for doing so. We're looking at a break at a 666.5. If that happens, let me tell you what's going on. Look down here at the bottom right. The bulls would then lose control of the week going into today. So that is how this is going. But what I plan to do in Kosi and the rest of the team, when we have that, and Jared, when we have our class, that is going to be phenomenal. And I've been telling y'all about the class so much, I'm just gonna, I gotta show you guys just a little bit, because I don't want you to, I'm gonna just give you just a little sneak peek. If you're familiar with slides, right? When you do slides, when you're doing a presentation, for example, I have slides right here, some real change slides. Sneak peek into the course that's coming up. Sneak peek into the course. Okay. I'm gonna show you where I'm at with it. Trading 101. From beginner to placing your first trade. Step by step, easy to follow, 8-week course. We will be meeting twice a week. We will have replays twice a day. Doesn't matter, whatever is best for you. If you could attend it live, great. If you need to watch the replay, great. But I'm giving you an example of the kind of work that I'm putting in. This is slide number 1. Right now, I'm currently all the way down to slide 216. Okay? And lower. I'm all the way down to slide 216. 218, really. Now I'm explaining down here the different type of options trading that you could get into. So I'm covering everything from the candlesticks to psychology, a beautiful outline with examples, everything. I'm going over everything, support and resistance, how to draw up your trading plan, how to protect yourself, how to grow your account, what you should look like, examples of that. So from slide 1, and we are already right now, currently, let me back that up because I don't know what I just did here. I'm already right now down in the 200s with the slides, and I still have a couple more to go, and I'm about halfway through. But I just wanted to show the team that progress. We're not playing any games. I'm showing you guys, going over these candlestick patterns, doing candlestick addition, how 2 candles equal 1, and you can still see these moves that I've been scalping off of, showing you examples of these things, example of live trades. Here, that beautiful 3-candle reversal with a hangman and a shooting star, where I got in, where I got out, live trade examples. It is going to be phenomenal. Anyone in you who you know that may want to learn this, that may want to adopt this, that may want to acquire this skill, this is going to be a must-have course. 8 weeks, meeting 2 times a week, and fully interactive. We'll be able to ask questions, go back and forth. If I need to spend more time in certain areas, then I will do that. I'm not going to rush through it. The whole goal is to make sure that at the end of the course, you started not knowing anything and you took a trade and made some money with us on the live. That's what I'm looking forward to. God willing, it is coming. I've had to slow down just a little bit due to me fasting this month, but there are no games being played. We going all the way. All the way. So I'm holding nothing back, completely transparent. And I'm even stating in the course, this is not the ultimate. I can only share with you what I know that is allowing me to be profitable. You can take that. You'll be able to add your own personality to it, add your own style to it, and create something that's completely uniquely yours. And that is what I'm most excited about. We all have different pain tolerance. We all have different risk tolerance. We all have different profit aspirations. But the basis, the foundation is going to be the same. And then we'll be able to express ourselves individually. And that's going to be a beautiful thing to see. And then I look forward to the day when you guys are helping someone and you guys are explaining this to someone, and I can sit in and just sit back and smile and take in what you guys are learning and sharing, because this is not going anywhere, and it doesn't matter how long it takes you. Once you got this, oh, the whole dynamic of your life changes. It's absolutely worth every bit of the effort, every bit of the discipline that we are going to put in. I thank you guys as well. Big shout out to the team. And now we're right back in a situation where we're hurrying up and waiting. Yes, sir. But I felt I had to show you that because I've been telling you guys for so long, and it's just taking me so long to do that, because like I'm really being thorough. Like I'm even going over the part where you even how to open up an account, how to get approved for the trade options. I'm really breaking it down for somebody who knows nothing. So some of this, you guys are, majority of this, what I might be covering, you guys already know. Just be a great refresher for some of you. For others who don't know anything, it'll be a great introduction. So I already know, I told some, I have a couple nieces and a couple cousins. I always got those couple family members that want to borrow some money. I said, well, listen, yeah, I'll give you some money, but why don't you come on and learn this skill? So one day you can give it back. So that's what I'm excited for. I'm excited to see what the youth can do with this. It just would amaze me what a young person and a young mind can do with this, and how fast they might grab it. Come on to the scene like Pac Riley. Yes, sir. I appreciate you guys as well. Again, man, I'm very humbled, and I'm very appreciative, and I'm very thankful. And I just want us to continue what we're doing, because we're not there yet. We're on the right road. We're definitely on the right road, and I definitely look forward to that day where we're all sitting down after a great day, eating a meal, and we fighting to pay the bill. Oh, I got it. No, I got it. What a great day that'll be, man. Yes, sir. Yes, sir. Amazing. Alrighty, back to business. Go ahead and blow up this 5-minute momentarily. This does look like a controlled selling algo getting ready to form. I need to see what happens here if we get another lower high. This is a bounce, and this candle will close in the next 45 seconds. This could be a potential lower high. If the market doesn't have the ability to break back into this controlled buying algo, it may be formulating and creating a controlled selling algo right here as well. Let us see. check the news real quick. Whoa, man. Oh, let us pray for peace. Let us pray for peace. Hackett says Iran new supreme leader is likely wounded. U.S. investigating attack on Iran girls' school. China's credit shows surprising growth as firms step up borrowing. U.S. consumer sentiment falls in early March as Middle East wars waves. And the war in Iran is driving costs up. Here are some ways to save. Very interesting. Right now, back at the top of that larger controlled selling algo, I need to show you that real quick. Let me highlight it. See what takes place here now. I want to lighten this. I want to lighten this. Alright, when I back it up now, you can see the selling algo coming in from yesterday pre-market. Okay, well, we had a high in yesterday's pre-market of 674. The next high was 672, and then we came on down. We then bounced back to that 672 today, and was met there with rejection. Okay, that rejection, okay, took us out of that controlled buying algo down here at the bottom, okay, back into the selling algo. We then tried to break back into it. This is a very key area here, this 670 area. Very key area as we have two algos in competition. And this is algos are computer generated trading. High speed computer generated algorithmic trading. You have to keep in mind the S&P 500 is the largest ETF there is. There are billions of dollars that are traded in the S&P 500. And they have high-speed computer algorithmic trading to take advantage of every slight move in the market. The beautiful thing about it, it creates a pattern that we're able to see and take advantage of if we're just patient enough and allow the pattern to reveal itself to us. Within this controlled selling algo, we had a beautiful buying algo, as we talked about this morning, that started off at 4 o'clock this morning as we put in a double bottom this morning at 4 o'clock. Beautiful control buying algo from 4 o'clock. Higher highs, higher lows, higher highs, higher lows. Then all of a sudden, once the market opened, we put in a lower low. We have now bounced from that lower low, but we're right here at a very interesting area. That's why we want to be patient, which is why I said above the 672, we will easily continue in that buying algo with these bears as liquidity to keep going higher. If the market wants to come down, let us wait, take a bigger position at the 666.5, as we would then be breaking this monthly support area, okay, and taking these bulls who are resisting down with us. All the bulls from the 666 up to the 671. If we come back to the 666, they now have to cover, which is why I chose the 666.5 for a safe area for a put and the 672.2 for a safe area for a call. Sometimes you have to take a step back to get a clearer picture. And that is exactly what's happening now with this bearish engulfing candle attempting to form right now. Now within this, I can show you the market opens selling algo right there. Momentarily, I'm going to remove the larger picture momentarily, so I don't want to have too many lines on the screen, confuse anyone. Okay. Momentarily, I'm going to also lighten this controlled buying algo because I don't want to confuse anyone. Pull up the 2 minute here so you can see it very clearly, just so I can show the illustration of what I'm talking about. Here is that active control selling algo that we are currently in right now. Needs a little adjusting, of course. Okay, there's the adjustment. Nothing is exact, but you can clearly see, again, we were in a controlled buying algo coming into market open. Market open, we retested at 672 again, found rejection there. That's where I got into that put off of that rejection, off of this clear, beautiful 3 candle reversal right here below the hangman. Nice little scalp. Then came right back in, went back to the top of the algo yet again, put in a lower high, called that out. Nice little scalp. Did not see this or participate in any of this, and that's okay. The original plan I called is for and below the 666, but still want to identify how we're going to possibly zigzag our way there. This is what we're currently in and experiencing right now. For easier way to look at it, let me go ahead and put this here for you on the Heikinashis as I do. You can see the bulls, when they had control, the change of command, the lower high, the bears taking over, the bounce back up to the top of the algo. Top of the algo came down. Top of the algo came down. Top of the algo came down. Again, still a very interesting area. An area of uncertainty for both the bulls and the bears. And as we now start approaching later time in the day, somebody's gonna have to make a decision here. I hope you guys understood that explanation. If you want a little more dalil, a little more proof, you can look here at the daily chart as I blow that up right now, as we have a very small doji. Yes, the bulls had control. They lost that. We went from green to red. The bears had control. Then the bulls stepped back in at the 667.7 area. And we now have a small body doji candle. And that has really been the case for a lot of days here past since the war. This is the daily chart. And since we've had that war, again, you can see the much larger control selling algo. This is backing up even further. This is showing you the daily charts. These are daily numbers. hitting the top of those algos, coming down, hitting the bottom of those algos, bouncing right back to the top of them. But very small, indecisive candles. And remember, I told you guys the other day, this big bullish candle was nothing but a bear squeeze after we had that gap down all the way to the 662.4. The bulls stepped in, the bears refused to let go, and then the bears got squeezed. But it was not sustainable because the very next day we put in this beautiful red shooting star, and then went doji, small body candle, and where we are right now as the market is coming down and closer to where I would personally like to get in if it gets there. If you're wondering about this move, whether or not you want to participate, simply refer to the larger chart. You got about 2 minutes left on this 15-minute candle chart. Refer to the larger charts. If you're thinking about getting involved, refer to the larger charts. Removing that control buying algo. She has been rendered null and void today.
To where we began weeks ago, because we didn't think the Iranians were negotiating seriously about a way to ensure that they would not pursue a nuclear powers, nuclear enrichment, etc. So to me, a win would be a negotiated settlement where we not just pocket the military objectives being accomplished, but we get inspectors back on the ground, inspectors from the International Atomic Energy Agency back on the ground to verify that infrastructure has been shut down, the cameras are back in place, they have the freedom to roam the country to look around, and we recover the 900 pounds or so of enriched uranium that is still outstanding and unaccounted for. And that's the uranium that we believe can lead them to make somewhere between 10 to 12 atomic weapons. So to me, that looks like a win, putting not boots on the ground, but putting shoes on the ground to get those international inspectors back in.
Mr. Secretary, look forward to next time. So many more questions about Hezbollah and the Houthis and the Kurds, but we'll save it for next time. Thank you so much.
Thanks. Good to be with you guys again.
Still to come, the Senate passing the largest housing affordability bill in 30 years. What it means for the industry with the head of one of the country's biggest manufactured housing players. But first, the CEO of software company Rubrik breaking down quarterly results and how its cybersecurity business could be impacted by the war. We'll be right back.
The market has my attention. The market has my attention now. Reestablishing my alarm.
After the break, CEO of Rubrik's with us, breaking down the company's results and what the war with Iran might mean for cybersecurity needs. With the Dow's gains shaved a bit now, up 100. Stay with us.
Trend Tracker is sponsored by CME Group.
I'm gonna go ahead and eliminate pre-marketing. We don't need it. Let's get a much richer view.
CME Group, where risk meets opportunity.
Potential call on the horizon. Potential call on the horizon. Market bouncing from the bottom of the algo, bouncing from the monthly support area, knowing that it's below this area that I'm interested in a put. The bulls are doing their best to defend this area because they know what happened underneath it. They know what's gonna happen if we get underneath this area. Again, I look for that safe money to call off for the team. That safe money is beneath this 666.3 area. Beautiful call scalp on the horizon. Call scalp on the horizon. On the horizon. A little early, but a beautiful red hammer here as support. The bull stepped in at the 666.3 area. If they get in a position where they are uncomfortable, they will have to cover. Beautiful, what I was looking for, right down here to 666. It bounced from it. Now let's come on down have a break and retest, and then maybe a potential nice ride to the bank. Other than that, just be safe, be careful. We know the areas for the trades. All we have to do now is just be patient. Thank you, guys. I appreciate you. Yeah, as Uncle Ben said, I just about went jumping in, but then he paused. Great job, Ben. Great job. That's what they want us to do. Whenever we identify an area where there's going to be safe money from us, that means somebody else is in trouble. Remember, Ben, we trade who's in trouble. We look for profit-taking areas and stop-out areas for both bulls and bears.
Welcome back. Rubrik shares are in the green
And
after
if
the
nobody else is
cybersecurity
in
company
trouble,
beat on
that means
earnings
we're
and
in trouble,
issued
and we
upbeat
want to
full-year
stay
guidance
out
to
of
stop
trouble.
trying to claw back heavy losses this year amid the cyber and software sell-off, and is still nearly 50% from its 52-week high amid the broader slump. Joining us first on CNBC is Bipul Sinha, Chairman, CEO, and co-founder of Rubrik. It's great to see you, Bipul. Welcome to the show.
Glad to be here, Sarah.
So clearly, I mean, business is doing great. You're seeing, what, more than 45% revenue growth, account growth. The market's trying to figure out whether you are an AI beneficiary or threatened by AI. Does it show up in the results today?
We are an AI accelerated company. If you look at our top line, we grew ARR 34% to the prior fiscal year. And we are delivering AI acceleration. We are actually giving people confidence that they can deploy agents and accelerate their AI journey because we are reducing their risk by giving them visibility and control, as well as availability of their core data and the AI systems.
What prevents an Anthropic or an OpenAI from moving into this area and doing this?
Rubrik cannot be vibe coded. We have about 12 years of customer experience and feedback built into our platform. We are not just a lame marketing automation software or some kind of a scheduling software. We are a data infrastructure. If Rubrik doesn't work, banks stop. You can't dole out money. The hospitals can't deliver customer patient care. So this is the core mission critical infrastructure that requires a decade of soak time for the software to be able to work for large enterprises. When ransomware hits, vibe code or LLM will not save you. Rubrik will.
I know you were asked about the war and Iran's sort of reputation as a troublemaking state actor. I wonder, I mean, although we don't want to see any malfeasance, is that going to drive at least awareness, if not revenue?
If you look at what happens in a geopolitical kinetic action, there is always retaliatory cyber attack. And there is a new phenomenon that we are seeing, which is attacking the economic infrastructure, which is now the data center, the AI, and digital infrastructure. So there is an increased awareness around cyber resilience, around digital resilience, making sure that economic infrastructure is intact. So there is definitely awareness, and we are seeing more orders come in because people are worried about, can they keep their businesses up and running? Can they keep their communication infrastructure up and running, data systems up and running?
And are those inquiries on new business, are they citing the war in particular?
Yes, they are new business and they are citing the war. We don't want to be ambulance chaser. At the same time, we want to ensure that all our customers and prospects can continue to run their business with confidence.
Are you able to break down like what percentage of the new business is coming from AI and securing agents?
If you think about what is happening in the enterprise today, to be able to adopt AI, they are actually accelerating their journey to modernization of the infrastructure, cloud transformation. And as you bring more software into the enterprise, you need more resilience. And that's what Rubrik drives. Rubrik drives data infrastructure so that people can build their AI orchestrator, agents, everything on the enterprise. And that's what we are focused on. And our acceleration, the business growth, if you look at, we delivered the most clean of all cybersecurity companies this past quarter. It is because of the AI acceleration.
Bipul, the AI sort of threat, so to speak, on the corporate side, in other words, displacing your services is one thing. What about on the incursion side, on the offensive side? Does AI and all this computing capacity that's being added make it more complicated or threatening to have those people potentially getting inside of corporate systems?
The history of technology adoption is the bad actors adopt technology faster than good actors. Because good actors have to worry about compliance and governance and making sure AI doesn't have bias. The threat actors are not thinking about all of that. So AI is everywhere when it comes to cyber attack. And then defenders have to adopt AI faster. And that's what we are doing. We are giving them the ability to make sure that their businesses are up and running when they're confronted with cyber attack. Our motto is assume breach. How do you ensure that your business has fundamental resilience and recovery capabilities so that you can continue to serve your customers?
Okay, Bipul, thank you very much for joining us on the quarter, what you're seeing, the overall concerns around the space. Bipul Sinha from Rubrik.
Thanks, Sarah.
Mike, our thanks to you. You got something special planned this afternoon? Obviously going to try to break down this entire week for sure, and also look at a little bit of the extreme fringe of ETF development, new ETFs based on widely followed investors' portfolios, things like that. See if they jump the shark or not.
We've already seen some personalization in those things.
Yeah, it's fine.
Mike, look forward to it. We'll see you this afternoon. When we come back, Goldman's chief global equity strategist Peter Oppenheimer is with us on how some international markets are reacting to this war as we continue to lose some gains here and the S&P goes red. Money Movers in a minute.
Good Friday morning. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla, live from Post 9 of the New York Stock Exchange. Today, Defense Secretary Pete Hegseth dismissing concerns about the closure of the Strait of Hormuz, saying, quote, do not worry about it. But we're joined by one energy expert who says the military situation actually might suggest otherwise.
A C-suite shakeup at Adobe, what that signals about mounting board pressures for companies to fine-tune some of their AI strategies before it's too late.
And precious metals pulling back as traders eye war-related inflation concerns. We discussed with the CEO of Wheaton Precious Metals, which is coming off a record 2025.
We're in the midst of a downside reversal here midday. S&P's gone red just a touch. We started out with every sector green except for energy. And right now, at the moment, we're only left with financials, utilities, healthcare, and staples in the green. VIX is back above 26. 10-year has been ticking up a couple basis points per day here, and that relatively elevated core PCE didn't help.
Yeah, I mean, I don't know if there was a trigger, but we did get a bunch of data today. A little hotter inflation, a little weaker economic growth for fourth quarter in terms of the look. Maybe that's stale, but concerns of rising gas prices, what the backdrop is going to look like. Also some stalled action on the durable goods, the buying heavy machinery and goods. Maybe that's factoring in here. We're going to start with the latest from Iran. Remarks from the Treasury Secretary, Eamon Javers in Washington. Eamon.
Yeah, good morning to you guys. We heard from Defense Secretary Pete Hegseth. He said today that the administration has been dealing with the Strait of Hormuz and there's no need to worry about it at the Pentagon press briefing this morning. He also suggested, but did not detail, that the U.S. military has options to get traffic flowing through the strait again.
Plan for every option here. We're working with our interagency partners, and that's not a strait we're going to allow to remain contested or with a lack of flow of commercial goods.
He also said that the quantity of Iranian missile fire has been dramatically reduced in recent days, and he called into question the physical status of Iran's new supreme leader.
We know the new so-called not-so-supreme leader is wounded and likely disfigured. He put out a statement yesterday, a weak one, actually, but there was no voice and there was no video.
Hegseth also responded to leaks that appeared in Politico this morning, suggesting that Vice President Vance privately opposes the U.S. war in Iran and is skeptical of the chances for military success. Hegseth called Vance an indispensable voice in the administration. And separately, guys, some sad news. U.S. Central Command said this morning that all 6 crew members aboard a U.S. KC-135 refueling aircraft that went down in western Iraq are now confirmed deceased. Back over to you.
Eamon, we mentioned that a moment ago, tragic news. Politically, there is this discussion of this supplemental and whether or not there is the appetite in Congress to fund it. Politico has a piece up today saying maybe not.
Yeah, one of the big questions is, what is the appetite on Capitol Hill for the financial costs of this war? We've been getting a variety of estimates throughout the week on that. And I think this Politico report, guys, on Vance is interesting, right? It's sort of a tell of what the thinking is inside the administration, because you don't get leaks like that if people inside the building feel this is going to be a successful, or this is a successful military operation right now. You get leaks like that when people are trying to put distance between themselves and the policy that's being executed. The spokesperson for Vance in the story didn't say anywhere in the statement that they gave to Politico that Vance supports the war. So I thought that was particularly telling in terms of the politics of all this, and we'll see how that shakes out in the administration.
Did Hegseth expand any further on options for Strait of Hormuz and how we're going to deal with that?
No, he didn't. And to be fair to Hegseth, you wouldn't necessarily expect him to. He said that media reporting was wrong, that they didn't have a plan for dealing with the Strait of Hormuz before the war. He said they did. Now, clearly, whatever that plan was, has not worked. But he said they do have options, and they're considering their options right now, but he didn't lay those out. Now, you wouldn't expect the military to telegraph exactly what they're going to do here, but if you hear some of the military pundits talking about this, one of the big challenges here has been in war games for a decade or more, planning for any kind of Iran scenario. The Strait of Hormuz is always extremely vulnerable. Because of the geography of the region, it might require U.S. ground troops to secure the Iranian coastline there, which could be an enormous military undertaking for the U.S. Army. And so he didn't detail what that might look like, but if you talk to the pundits, that's kind of what they're saying it might end up being.
Eamon, we'll talk in a bit. Thank you. Eamon Javers in D.C. for us today. For more on the impact of global markets, let's bring in Peter Oppenheimer today, Goldman Sachs Chief Global Equity Strategist, Head of Macro Research in Europe. Peter, it's always good to get your take. Thanks for the time.
Thank you, Carl. Nice to be here.
I noticed this morning Goldman does raise their Brent average forecast for the month to 100. We've been waiting for the street to start shaving earnings estimates or year-end, targets on the indices. We haven't seen it yet. Are you in that neighborhood?
Well, no, not really. Firstly, yes, we have raised our oil price target and shaved a little bit off our growth forecasts for the end of the year in the US, for example, to 2.2% quarter on quarter, fourth quarter on fourth quarter average from 2.4, and somewhat similar in other regions as well. But we have to also recognize that underlying profit growth has been pretty strong, and there are some technical factors that sort of reduce the negative effect of this slowdown on overall earnings. For example, take the US, if you look at the most oil-sensitive sectors, consumer discretionary, consumer staples, and energy, they're much smaller in the index than the sectors which are not really affected by the rise in oil prices. Roughly half the weighting of infotech and communication services. In some other markets like Europe, the earnings are actually benefiting from weakness in the euro and also some rise in oil prices. So overall earnings are still an important support here, even as the growth inflation mix deteriorates a bit.
So how much do you lean into the economic weakness story as a result of the high oil prices?
Well, so I think it's important from a market perspective because the context here has to be reflected, and that is equities broadly have been performing very strongly up until this war, and even through the last week or two. The setback has been pretty modest, especially in the US, down around 3%, to Europe, around 9% in dollar terms. But when you consider that most equity markets have valuations which are well above their long run averages, and they've had a very strong run up over the last year or so, and also equity risk premium are quite low. I do think that despite the solid underlying earnings, equity indices are still vulnerable in the near term to further correction. But we would see this as a correction rather than a significant bear market risk.
Peter, on the banks, we've had some other global desks overnight say that yesterday maybe credit markets are approaching a non-linear inflection point, going net short financial exposure, people watching some of the BKX and the XLF. Are you worried were you worried prior to hostilities and even more worried now?
No, in the sense that we've liked banks for a long time. Generally, they've been generating very strong profit growth, particularly actually in the areas where banks had hitherto been very weak, especially Europe. Steeper yield curves have helped. The macro backdrop has been healthy, at least up until now, and that's been good for banks. But there's been growing concern about private credit and also a potential slowdown in capital markets activity relative to the pretty buoyant expectations at the beginning of the year. But overall, I think the banks are resilient, they've got strong balance sheets, and we would still put recession risk as pretty modest. Take the US, for example, our economists have raised their recession probability to around 25% for the next year. Certainly more elevated than it was, but that wouldn't be anything like a central scenario. And I think in that context, bearing in mind that banks in many regions are profitable, generating strong cash flows, paying dividends, in many cases buying back stock, I think that they will recover and rebound from this and remain a pretty strong sector in the market.
So U.S. looks resilient here, Peter. Does it cloud the rest of the global outlook more? Is that a reason, for instance, the dollar's been going up nearly every day since this war began?
Yeah, absolutely. Look, the U.S. has once again proved to be resilient in the face of shocks. The dollar has reversed a little bit the weakness that we were seeing as a dominant trend through the last year, and that certainly helped. And bear in mind, to the point I mentioned earlier, underlying profit growth, particularly in the US, has been very strong, and the leading tech companies have very strong balance sheets, and that I think has added to its resilience. Bear in mind, other markets had been outperforming the US in the last year, and for the first 2 months of this year, that pace of outperformance was actually accelerating. So I think from a higher positioning point and also more valuation expansion, other markets have pulled back to a larger degree. And I think that makes sense in the context of this uncertainty. If, as we expect, oil prices by the end of the year come back down again to roughly around $70, and the overall effect on economic activity is relatively modest, I think you'll still see the broadening diversification trends of the last year or so reassert themselves. And I think there's some good opportunities outside of the US, particularly in EM, where we've seen some selective strong sell-offs, but I think still very strong underlying profit growth and good prospects for returns.
Oh, that's good. That's a good gut check. Of course, the longer this goes on, we may have different versions of this conversation in the weeks to come, Peter. Hope to stay in touch. Thank you, as always. Peter Oppenheimer.
Thanks so much for having me.
Still to come this hour, a top energy and geopolitical analyst on why he says the war in Iran will disrupt safe commercial transit for at least another month.
Leadership change at Adobe, how the next generation of software CEOs may need to adapt to curb some of these displacement fears as Money Movers continues.
Are you starting to think, if this does keep persisting as it is, that the Navy has to go into the Strait of Hormuz to help ships get through, which would have a big effect on
look, that was always in our planning, that that there's the chance that U.S. Navy or perhaps an international coalition will be escorting oil tankers through. There are, in fact, tankers coming through now, Iranian tankers, I believe some Chinese flag tankers have come through. So we know that they have not mined the straits.
That was Treasury Secretary Scott Bessent yesterday telling our colleague Wilfred Frost the U.S. Navy could begin escorting oil tankers through the Strait. Our next guest firm says oil flows in the Strait of Hormuz could reach, quote, full normalization by around April 10th. Joining us now, CEO of energy and geopolitical analysis firm Rapidan Energy, Scott Modell. Welcome to the show.
Good morning.
You guys go really deep on the Strait of Hormuz and the energy analysis here. First of all, is it possible? Is that what you expect to happen for the U.S. Navy to start escorting ships to get through?
We do. We don't think it's going to take less than 2 to 4 weeks, though. I think as we go, we're starting to see how much they've not done and that it's going to take longer than they expected.
Why is that? Why is it taking long?
Well, I don't think they were prepared. I think that they thought a number of things. They're coming out of the conflict. They thought that Iran wasn't going to go right after energy. I thought that they thought that Iran was going to capitulate a lot faster than they have. And I think they thought with the forces they had arrayed there, it would be more than enough. And even though, like we've been telling clients for a very long time, and the U.S. military and the intelligence community and D.C. has known for very, very long that Iran's main go-to form of leverage is asymmetric, and therefore all the things you're starting to see trotted out, mines potentially, small boats, fast attack craft, coastal batteries, millet rockets, so forth, drones. We've known about that for a long time, but I really think they focused on a lot of other target sets, and to their own detriment, they've been slow to deal with the more immediate threat in the Strait of Hormuz.
Do you need troops to secure the coastlines?
I don't think you do.
You don't need?
No, I don't think you do. Because there's plenty they can do from Oman and from the region that would allow us to actually, over time, attrit those asymmetric threats to the point where the Iranians are not going to have the ability to prevent us from creating an escort. But it's just going to take time. And I think the real risk is we're really one good attack away from crude going from where it is today up to 120 or higher. So for us, the risk that we get into much higher levels of Brent is very high, and it's going to go on the longer this goes on. And I would mention what we've seen to date with regard to what the Iranians have done is a small fraction of what they can do. So there are other things we haven't seen a single mine explode. We haven't seen a mine detonate yet, but the mere mention of mines has gotten people nervous. All they have to do is use one of several simple ways of doing mine laying, and
it's terror, right? It's fear-based terror.
Absolutely. Yeah.
And that's enough of a deterrent for any crew or tanker company.
Crew, insurance, tankers are going to think very, very carefully about going through if they know that mines are going off. Absolutely.
So they have that, because I was wondering. I mean, aren't we successfully targeting their naval ships? Like how much they can maintain and control themselves over the Strait of Hormuz?
We've hit their we've sunk a lot of their blue water naval ships, but those are old rickety frigates and vessels that really, at the end of the day, in any type of conflict that we could have imagined, wouldn't have played that much of a role anyway. We've hit mine-laying vessels, but really it's not about that. What presents the biggest mine threat is the middle of the night. They can take fishing vessels and dhows and a lot of other things that are much harder to detect, that are low cost, low tech, and lay mines.
How small, how decentralized can they get? How small of a troop, for example, can pose a threat to a tanker that's sitting out there?
3 to 5 people.
3 to 5 people?
3 to 5 people in very small, tactically semi-autonomous, dispersed units, which they already have in
Separate
motion.
from Central Command.
Separate from Central Command. Separate, and their whole doctrine, asymmetric doctrine, is something they've been planning for a very long time.
Do Gulf states' patience, does that run out? In which direction?
I think it runs out. I think they're going to be looking very carefully at how this goes for the next 2 to 4 weeks. I think you're already starting to see signs that the president is losing patience with this. I think you're seeing signs that the Israelis, who I think are a big driver of this, even if President Trump were to say, okay, enough, we declare victory, it's time for us to go, there is an Israeli factor that's somewhat different. And I think there is a possibility of continuing this beyond a U.S. exit. And I think the Gulf countries are going to want to see how that plays out.
So your April 10th date of normalization in the Strait of Hormuz is contingent on what?
April 10th is contingent on getting the convoys in place, getting escort runs done. Remember, you have to actually reassure tanker owners and operators and crews and everybody moving through that space that it's safe to do so. We haven't done that yet. So you need to do dummy runs with tankers to show the mines have been cleared. And that is a very complicated and weeks-long process.
Can the Saudi pipeline be enough of an offset to keep oil prices in somewhat of a check?
I think it can somewhat help, but it's not going to be enough. When you have 20% of the world's oil source, the world's main artery shut off, there's only one thing to do to resolve this, and that's to reopen it.
Yeah. Okay. Well, thank you for joining us.
You're welcome.
We appreciate the work on this that you've been doing. Scott Modell from Rapidan Energy.
When we come back this morning, Adobe shares in the red today after announcing that leadership change nearly 20 years after Shantanu Narayan took over. We'll take a look at his tenure, look at the pivot to the next generation of software chiefs who may have to make some steps to avoid disruption.
And then the CEO of Wheaton Precious Metals is with us. His reaction to earnings, plus how he's thinking about the outlook right now for gold and silver during wartime. Money Movers back after a quick break.
Adobe's the latest software company to reshuffle leadership as these fears of AI disruption hammer that sector. Our Seema Modi is back from D.C. with more on today's Tech Check. Hey, Seema.
Well, Carl and Sarah, it's clear that AI is prompting some major leadership changes. The latest is Adobe CEO Shantanu Narayan, who announced last night he is transitioning out of his role once a successor is found. He led Adobe for 18 years successfully through the cloud transformation, but with AI becoming a bigger threat, investors have been left impatient. The stock is down about 60% from its record high. Despite new Gen AI capabilities in the latest quarter, annual recurring revenue did decelerate. Adobe isn't the only company in software that is changing up the C-suite. Workday bringing back its founder Anil Bhusri, call center software company Five9 announcing a new CEO recently, MongoDB appointing CJ Desai, formerly Cloudflare, back in November, but recently consolidating its C-suite positions. Asana with a new CFO who previously held a high-ranking position at NVIDIA. And guys, more changes are expected. We spoke to a few M&A bankers who say corporate boards are conducting reviews real time. They're assessing whether management teams have the right product experience. They say they want visionaries who can lead these companies through this transformational shift that's happening due to AI, while also, guys, having a deep structural experience in M&A as we're expecting more consolidation in the sector.
Question is, are the people that they're appointing as new CEOs, prepared to take on this new fight? Because, I mean, like Workday, for instance, they appointed one of the founders, right? So it's like, what skills do you need? What are boards looking for when it comes to taking on the AI revolution, transformation, if they're going to be replacing CEOs?
Kind of reminds me of what happened with Intel last year, too. Someone who has deep technological experience is what these boards really want. ServiceNow CEO Bill McDermott spoke to you guys in the last hour talking about this is a time of business reinvention and that the stakes are really high. And also reminds me of the conversation we had with Palantir CEO Alex Karp yesterday, even beyond the C-suite, the structural change he's anticipating just across the workforce. And he thinks this is going to become more of a political problem. He says it's a quite dramatic transformation in technology that is going to disrupt humanity's trained, largely democratic voters. He thinks this is something that state and federal representatives need to address to protect their citizens, whether it's upskilling or figuring out what this could mean for their jobs.
Yeah, I thought that was a really interesting comment. So he's saying that it's going to disrupt the Democratic base?
Yeah, he said largely Democratic voters make their economic power less and increases the power of vocationally trained working class male voters. Which this is something that states need to focus on.
That's who's going to lose their jobs,
right?
Women.
I didn't expect you to get into that with him, but I mean, over the years, blue-collar workers have largely been union and largely been Democrat.
True.
No, union leaders Democrat. Union members.
It can, ebb and flow depending on what industrial towns they're in. But that's a good point.
Yeah.
And we're seeing this sort of change happening real time. And the question is, are political leaders being aware of what's taking place?
I mean, it was a very interesting point that he made that got a lot of attention, Seema, that Alex Karp interview. Thank you.
Thank you.
Time now for a news update. Frank Holland has it for us. Hi, Frank.
Hi there, Sarah. Workers at the Department of Homeland Security are missing their first full paycheck today as the partial government shutdown is entering its second month. A bill to fund DHS failed in the Senate yesterday as Democrats push for new restrictions on federal immigration officers. TSA absences, they've doubled during the shutdown, leading to long security lines at airports all across the country. Ukrainian President Vladimir Zelensky is meeting with French President Emmanuel Macron in Paris today as Ukraine seeks reassurances of support in its fight with Russia. Zelensky said a U.S. decision to ease sanctions on Russian oil does not help achieve peace. The visit comes as the EU weighs a proposed €90 billion loan for Ukraine. And the American Gaming Association estimates that Americans will legally wager $3.3 billion on this year's NCAA men's and women's basketball tournaments. That would be a 54% increase over the last 3 years. March Madness, it kicks off next week, so get ready to fill out those brackets. Sarah, back over to you. Do you have a pick for the brackets? Do you have a team that you root for?
I haven't done mine yet, but my kids have. I think they're with Duke. I think they think that Duke is going to win it.
Okay. A good pick.
A lot of Duke fans in our family. Thank you.
Thanks,
Frank
Sarah.
Holland. After the break, we're going to talk with the CEO of one home builder who could stand to benefit from this landmark housing bill that just cleared a key Senate vote. CEO of Capco joins us after the break to explain why.
Plus, a newly proposed wealth tax looks to eliminate income tax for the majority of Americans. We'll get to that story in just a minute.
Welcome back. The Senate passing a bipartisan housing affordability bill in hopes of boosting supply and preventing Wall Street from buying single-family homes. Our next guest is one of the country's biggest providers of manufactured housing and joins us now with his outlook. Let's bring in Capco Industries CEO Bill Bohr. So, Bill, tell us a little bit about what you do and how it's different from some of the other home builders in the industry and why you're so supportive here of this bill.
Yeah, I mean, the bill's great for all of housing for sure, but we're a factory-built housing company. The majority of the homes we make are under a federal code administered by HUD, but we're essentially building the complete house in a factory setting and then transporting it to the location where it then gets set up for the residents. So last year we produced about 20,000 homes, which actually puts us, if you compare that to site builders, puts us within the top 10 home providers in the country.
I'm sure you're all for, the streamlining of some of the environmental reviews and all of that, what's in the bill. But, the National Association of Housing has been against this provision that would require institutional investors to sell build-for-rent single-family homes within 7 years. They say it would severely reduce investment in rental housing and could slash single-family production by nearly 40,000 units per year. Do you disagree?
Yeah, I think we have to be careful about the exact provisions about how that's, and there's been a lot of work on the language in the legislation over the last several weeks to do that. So, it'll go to the House now and there will be more work to try to figure that out. We understand the intent. In the end, I think the impact of institutional buyers that would come under a ban here is relatively low in the scheme of housing. But again, trying to make sure that we're not cutting off incremental supply that those institutional buyers create is important, because this affordable housing issue is a supply side issue. So we want all forms
you want to
of
take
housing.
you want to take out this provision in the House version. You're going to try to help make that sure that
Not
happens.
necessarily. I'm just saying the final language is something I know a lot of people are negotiating, and I think that's right to make sure it's not counterproductive.
Bill, how about an update on pricing pressure, whether that's overall commodities or increasingly, I would imagine, energy?
Yeah, for us, the impact of things just generally is on the consumer to a great degree, right? People are having trouble having the ability to save and to spend the monthly costs of their housing. So generally inflation, I think about more on the consumer side, but we certainly are subject to inflationary cost pressures. The good thing about factory built housing is we're a lot more efficient than site builders with our materials and our labor. And so we fare pretty well under any kind of inflationary environment from a margin perspective. And we're able to build the same structure as a site builder for about 30% less cost.
What's happened to your prices over time?
They've gone up, but we've been flattish for the last probably 2 years or so. So they went up as everything did kind of in the COVID years. And but we've been able to hold them pretty steady over the last 2 to 3 years. For us, a smaller home that we would make might retail for about $100,000, and a larger multi-section home, if it's 2 sections, it might be about $175,000 for the structure. So very competitive and really hitting price points site builders can't hit.
And those end up, I imagine, getting financed, and with a monthly payment around what?
Yeah, they're getting financed, and the interest rate's just a touch higher than for a site build home, which you could argue is a negative that's just not deserved by the industry. But I don't know if I could give you off the top of my head what those 2 price points would be at the current interest rates, but we're certainly hitting price points, and we're the most affordable form of construction. So we feel we're a solution to the affordability issue, and I think that both parties are focused on that. And you see that with the prominence of manufactured housing in the legislation.
So are you gaining share right now, given that home price affordability has been an issue in recent years?
Yeah, we have. Just HUD code homes built under the federal standard is kind of bouncing in the low teens as far as a percentage of new starts. And we should see that going up. One of the big problems we have is that we traditionally sell into rural areas, and we're zoned out in many times. And those zoning restrictions are really based on past mindsets. They make no sense with our current quality of product. So if we can get access to urban environments, we're going to really be able to play a bigger role in providing homes site builders just can't provide.
Yeah, well, now you're getting to sort of the mess, the puzzle that is sort of local permitting, state permitting, county. I mean, is there any attempt to create a collective action movement that would move permitting one way or the other?
Well, I think we need action at the federal, state, and local level, and ultimately the local municipalities drive zoning decisions. But more and more, we're seeing states pass legislation as well, making sure the playing field's even for factory-built housing as well as site-built. So while it's frustrating because we know we could get more families in great houses, I do think that we're making headway. And again, the bipartisan support right now, it's a big voter issue, and so it's a big political issue for both sides. And we're thrilled that the legislation went through, and we're thrilled with the prominence that manufactured housing is getting in that legislation.
Is it 5% of U.S. households still in manufactured
That's
housing?
right. Currently about 5% of U.S. households, roughly 17 million people live in our homes. And, they're quality homes. We build to a federal code that is at least as stringent as site-built, depending on the locality. So any thought that these are lower quality homes isn't true. And it's almost hard to compare to site-built because, again, site builders just aren't able to hit these price points. So we're aimed at exactly where the affordable housing crisis lives. And we just want to be able to get into urban environments and get people in good homes.
Yeah, I mean, it does feel like there's recognition that there's a supply issue in this country, at least by the government. Bill, thank you for joining us with the perspective. Really appreciate it. Bill Board, the CEO of Capco Industries.
Still ahead this morning, a new sales pitch to tax the wealthy, and this time the revenue might be used to eliminate income tax for most Americans. We'll talk about how that might work after a break. Welcome back. A newly proposed income tax aims to eliminate the tax entirely for many Americans. Our Robert Frank is here at Post 9 with that story. Today's edition of Inside Wealth.
Good morning, Carl. Good to see you. Well, a group of Democratic senators yesterday proposing tax legislation that would exempt millions of Americans from income taxes. But to pay for it, high earners would see big tax hikes. So under the bill, any income up to $46,000 for individuals or $92,000 for couples would not be subject to any federal income taxes. Now, to fund it, taxpayers making more than $1 million a year would get a progressive tax hike. So those making between $1 and $2 million would pay an extra 5% for a total top rate of 42%. That rate would climb from there. So those making more than $5 million a year would have a top federal rate of 59%. So what does that mean? Well, someone here in New York City making more than $5 million a year, their combined state, city, and federal rate would be over 73%. For New Jersey taxpayers making more than $1 million a year, the combined state and federal rate would be over 69%. Now, Democrats have made tax hikes on the wealthy a key policy for them this year. The Washington State House just passing this week its first ever income tax. Taxpayers making more than $1 million a year would pay a state rate of 9.9%. It now goes to the governor, who is expected to sign it. Now, for more on the new plans to tax the wealthy across the nation, you can sign up for the Inside Wealth newsletter at cnbc.com/InsideWealth.
Do these Democrats not see that billionaires and businesses, corporations, are leaving high tax states like we've never seen before to move to lower tax states? Are they trying to chase them out of America?
What they see is in Massachusetts, where they imposed a new surtax on high earners, that revenue has been more than double what they expected, and the economy has done well. What they see is in New York, the actual number of millionaire earners has increased since in the past 3 years, 5 years, 10 years, you name the period. So we did have some out-migration. Now, what you're right about is that when you compare it to the overall increase in millionaires nationally, California, New York, New Jersey, Illinois, exactly, and that growth in those high-tax states has been way below the growth in other states. So you could take either side of the argument and find statistics to prove your point, but this has become, especially if you can take that money from the rich and write a check. In some cases, some are saying, well, let's give checks of $3,000 to those who make less than a certain amount. If that money is going directly to middle-class taxpayers, that becomes a lot more popular from a voter perspective.
So you're saying they're going to put up with some outward migration, but the revenue makes it worth it.
They refuse to acknowledge there is outward migration. They say, look, Howard Schultz, we just saw he moved from Seattle to Miami. Not coincidentally, it was during the House argument over this tax. Now, he didn't say that was the reason, and no one's responded to that on the proponent side. So what they would say is, yes, some will leave, but we're creating even more wealth that's replacing it. And so you look at a place like Washington, you've got Amazon, you've got lots of tech companies there, Microsoft, and so they would say, look, those companies continue to create jobs, and they're going to stay. So.
I wonder if you think politically, I mean, $1 million isn't what it used to be, to be honest, and whether or not it's still as potent a political message.
I think very much so. For Americans that are under pressure with inflation, for inequality that now by many measures is at an all-time high, for most Americans who could dream of making $1 million a year, that is still a level that's very popular. And it's about 1 million taxpayers. So it's sizable, but it's still the vast majority of Americans can say, well, it's not me that's paying the higher taxes. So we'll see.
If the Democrats win the midterms, is this the kind of stuff that we're going to see happen?
What's interesting to me is that the party has become very energized. They're looking for a message right now. They need a message to appeal to that populist base that switched to Trump. This is their message. We're going to tax the rich, and we're going to give those proceeds to tax cuts for the middle class. That could be very popular.
Okay, Robert, thank you.
Thank you, guys.
That's a preview, I guess. The CEO of Wheaton Precious Metals coming up with us after the break, just reporting big beats on the top and bottom lines last quarter. His outlook for metals and investor sentiment during this war in Iran. Don't go anywhere.
Welcome back. Take a look at shares of wheat and precious metals today, down about 3%. Despite a beat across the board in Q4, bullish production guidance for the year ahead as investors have all eyes on gold and silver last few weeks amid the war with Iran. Joining us for a closer look at the quarter is wheat and precious metals CEO Randy Smallwood. Randy, good to have you back. Thanks for the time.
Always a pleasure, Carl.
Last time we spoke, I think gold was still very much ascendant. This dollar strength has sort of thrown a new wrinkle into the equation. What do you make of it?
Well, I mean, I think it's a kind of a typical response that we've seen. I mean, obviously, the conflict in the Middle East has pushed a rush into U.S. dollars. We typically see that whenever we see a new conflict starting on geopolitical perspective. And I think over time, what we'll see is, again, a shift away from U.S. dollars back towards gold over the next few weeks. And so, it's the same response that we've seen in when the Ukraine conflict started, and we've seen it in other situations. So not to be unexpected. Still very bullish in the long term.
How much? I mean, tactically though, what kind of retracement do you think would begin to get extreme on the downside?
I have a hard time seeing. I mean, to be honest, I've been surprised at the resilience of gold. Well, not surprised. I mean, I am known as a bit of a gold bug, but I think gold has actually shown strong resilience. Staying solidly over $5,000 an ounce. And so, given the strength of the U.S. dollar relative to everything else, the fact that gold has held its own as well as it has, we're still seeing strong buying by central banks around the world, even at these record prices. And so, I just don't see that backing down. And so, I have a hard time seeing it getting down below that.
Do you think gold has changed as its investment appeal from a safe haven to something else?
Well, actually, what I think we've seen, Leslie, is a paradigm shift in gold, and both gold and, to be honest, silver. I think we've seen kick up too, and I just think it's a new relationship with the fiat currencies of the world. There's just been when I sit and look at central bank reserves, we're still nowhere near where we typically have been from a percentage of central bank reserves, gold making up that. We're only about halfway up to what is sort of a normal average. And so the U.S. dollar has been really dominant in that space over the last 40, 50 years. But that dominance is ending. Gold is now, getting to be a larger portion than even U.S. dollar in terms of central bank reserves. And that trend hasn't changed. And so we still see that feeding forward.
Randy, when it comes to production, what are some of the biggest energy inputs? And are you beginning to see shortages or pricing pressure as a result of the war?
There's no doubt oil and mainly diesel, of course, at sites, and a lot of the sites are actually remote. So even the power generation, consumes the diesel, and most of the grids now are still fed by petro or oil. And so there's no doubt it's going to have an impact on costs. Again, it's one of the advantages of our streaming model is our costs are fixed, but there will be cost pressure. There has to be. There's such a big gap between gold and the spot price of gold. We're going to see a continuous cost pressure across the board, pushing up the costs of the traditional mining companies. That's again one of the advantages of Wheaton. We really try and reduce that risk for our investors, our shareholders, and try and limit that.
Are you beginning to game out what happens if shortages, quotas, export controls start to really limit the supply of refined product to some of the production sites?
Yeah, I think that's the advantage that we have at Wheaton is that we really do focus on first and second quartile assets, because then there's enough margin to manage those type of challenges. If you're a high cost producer and you start having a bit of extra burdens with respect to, just say, limitations, restrictions, etc., quota, supply quotas and stuff like that, you can't afford to get around that. And it's one of the reasons why 85% of our production, we've always focused on first and second quartile, and 85% of our production comes from high margin assets that really protect us from that. And the operators will, they might have to pay a bit more to keep operating, but it's definitely much more important to stay operating than it is to actually have to shut down through that. So again, it underscores the importance of focusing on high margin assets.
Well,
Randy, it's Sarah, by the way. Just wanted to ask you about silver. That's okay.
Second profit target we're looking for is going
silver
to be
is interesting too, because people like it for similar reasons to gold, but also has more industrial use cases around AI. Is there any? First of all, what does demand look like, and is there any supply chain risk out there with what's happening in the Middle East? around silver?
Yeah, there's no doubt. I mean, again, supply chain risk, it's going to be increased costs across the sector, across the entire mining industry. Just the increase in oil prices is going to drive that. But it is one of the attractions that I do like, Sarah, about silver, is that it's very tough to find good silver mines. I mean, it's one of the reasons why we were so excited to close that transaction earlier this year, the $4.3 billion acquisition from BHP, the largest mining company in the world, because it's a high-quality silver stream, a silver production profile that it's very tough for us to see opportunities like that. It's one of the reasons, even the gold bug that I am, I actually like silver better. The challenge that I have is that we have a real tough time finding new silver production anywhere. There's just not a lot of it available. Most of it is produced as a byproduct from lead zinc mines. Nobody's building lead zinc mines nowadays. Lead zinc is not in high demand. And then you look at this, the demand side, high efficiency electronics, which is where we're going. If you want good data centers, if you want AI coming into play, the more silver we use, the better everything operates. Silver conducts energy, electricity, knowledge, all better than any other metal out there. And so we're just going to see increasing industrial demand. The demand is coming from everywhere that we're focusing on as a society to try and continue improving. And so I'm excited about silver.
Yeah, I mean, it sounds like it is really supply constrained as well.
Oh yeah, it is. Silver's always had higher beta, higher volatility than gold. And one of the reasons is because the bulk of silver doesn't even come from silver mines. It comes from lead zinc mines and copper mines. And so, the challenge is those mines don't adjust production just because silver shot up to 80, 90 bucks an ounce. Those mines, the bulk of their revenue does come from lead, zinc, and copper. And so they're more driven and they don't ramp up production with higher prices. And so it's a very restricted supply side for silver.
Finally, Randy, President is still scheduled to go to Beijing and meet with President Xi. I just wonder what kinds of things you'll be looking for headline-wise when it comes to the security of any kind of commodity.
Well, I mean, when it comes to the commodities itself, fortunately, I think gold is truly a global commodity that isn't subject to political influence. It's widely available, recognized, and respected around the world, and so we're a bit immune from that in the gold and silver space. But the industrial demand, obviously, increased industrial demand will have probably a bit more of an impact on the silver side, and so we'd hope to see some cooperation there that would promote that. I'm a strong believer in the efficiencies of global trade and trying to maintain sort of equal competitive platforms in terms of supplying those materials. And so, as long as we can keep going down that path, I think it's better overall for society.
Yeah, it's definitely a big debate at the moment, Randy. As always, our thanks. Good to see you again. Randy Smallwood over at Wheaton.
Always a pleasure.
Next week's going to be very interesting because central bankers enter the picture. We've got a Fed meeting, and not just a Fed meeting. European Central Bank, Bank of England, Bank of Japan, they all have scheduled meetings next week. I think most all of the G7 actually central banks, and they're not going to be able to avoid talking about oil and whether that increases inflation risk.
I know. The CME Fed Watch Tracker now has a column for hikes. Did you notice that?
Oh, no.
Is that now is part of the discussion?
We'll
see.
Powell has said it hasn't been the base case. I wonder what he'll say as the president calls for intermeeting cuts.
Yeah. Let's get to the judge over at Post 9.
Carl, thank you. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. Stocks looking for some footing today after the worst day in a month. There is lots to trade. We will do it with the investment committee, as always. Joining me for the hour, Stephen Weiss, Kevin Simpson, Jim Leventhal, Bryn Talkington. Show you what we're doing here. We did have a nice rally at the open. It's all but disappeared. Crude is now moving up. It was lower. The market liked it. Now crude is higher, moving back towards 97 a barrel.
I'm definitely going to wrap it up here.
Pretty obvious at this point.
Definitely
Stocks are going to have a hard time finding the footing that I suggest they're looking
Potential
for.
Reversal here
as long as the Strait of Hormuz remains effectively closed. Despite efforts by members of the administration to ease concerns about that, there are plenty of concerns. And that's why the market looks the way that it does.
Yeah, and that's something you can't spin. The administration saying, look, well, the Navy has scored, it's fine and all this, it's going to consume. You can't spin it because there are too many pictures of the ships lining up and too many announcements of nothing getting through. And that's what's driving the market at this point, as you point out. Because if you keep oil prices elevated for so long, you have the chance, and you hear the R word more and more, meaning recession, of coming through. So my position has been, look, I'm keeping my cash. I don't want to catch a falling knife. I don't know how far it's going to fall.
If the bounce is
I did, in your
unsuccessful,
absence, put on one trade.
watch out, 659
FTAI, which I thought had come down enough, and I'm going to close that trade out probably later today or tomorrow. It's been a major loser. So this is not a trading market, and my regret is that it's prone to doing stupid things. You know, you see something and said, wow, how can that go down another 25%? And guess what? It's on its way down. So to me, it's just keep your hands in your pockets. You have different strategies if you're long term or if you're intermediate term, short term. If you're long term, look, frankly, any place you buy, if you buy the right stocks, they'll be higher in a reasonable time frame. But if you're a trader or you're focused shorter intermediate, then it's not so easy to determine.
I'll just give people one more look. You throw WTI up intraday and then put the S&P intraday back up, because it really tells the whole story. I know that we keep mentioning that, but how can you not? Just given the way that the market continues to trade. I thought it would be wise, I think, 2 weeks almost into this conflict, to take a look at what the major averages have done. S&P's down about 5% now. So you're not in a pure 10% correction, but you know, the negative news flow has many on Wall Street thinking that the risks are still decidedly to the downside. Goldman's Tony Pasquarello says if there's asymmetry to the S&P, it's more likely towards the downside outcomes than upside. And that suggests local risk reward is not in favor of the bulls. How would you assess that, Bryn? It's pretty obvious what you need to keep watching to decide whether this market's going to find a little bit of footing, as we suggest.
Yeah, and I think, you know, Tony also so appropriately said time is the enemy around energy prices and the war. So I think all you need to do is look at what energy prices are doing to see what the market's going to do. I think we also have the 200-day moving average for the S&P is 6,600. So we're only about 47 points away from that. I think people will continue to be skittish going into weekends, the longer this lasts. I do think, once again, this crisis is not like Venezuela. The mullahs has been in power for 4 decades. I don't think they're going to leave easily. And so I think that does rightfully have investors nervous that we don't want a long, drawn-out war. And so I do think this is going to continue to dominate not only the headlines, Scott, but just the markets. And so 6,600 seems very plausible. That is somewhat gravity for the market. And so I think investors, you know, should be prepared if we have some more turmoil. That 6,600 is really the next strong support for the S&P. And I do think, I'm talking my book and Kevin's book, this is a great time to be selling calls. And so I think that's where the premium's high on a lot of names. So you can sit still in your names and sell calls. And that's been a good strategy all year long. And so we'll continue to do that and collect that premium while we have this really elevated volatility.
Jimmy, what's your view?
Well, I'm sorry to make it as simple as what we've already said, but it comes down to the Straits of Hormuz. It really is that simple, and nobody knows, certainly not me, when they will open. But I do believe that when you get that announcement, however it comes, maybe it's actual ships flowing, maybe it's, I mean, we know we really can't rely on the word from the administration. I'm sorry to say that, but we've had too many false starts in that regard. When the market feels that the Straits of Hormuz are open, it is likely that the markets will go much higher. Now, one asterisk to that. We can't have the Straits of Hormuz closed for a long time and then expect everything will be rosy when they reopen. So as I said yesterday, Scott, it really is in the month of March that we have to resolve this. After that, there is lasting damage. Now, what does lasting damage look like? Well, we're going to be in the pre-announcement season next week. And if you start to see pre-announcements from companies, that will worry us. If you start to think that maybe the earnings might be affected for more than just the first and second quarter, that's the sort of lasting damage that we need to look out for. Again, I think if you get this resolved by the end of March, we should be okay, but a lot of uncertainty here. The market's responding as it should be.
At least 2 more weeks, at least if your timeline plays out of volatility, if nothing else.
Yep.
Kev, so Michael Hartnett of Bank of America today, with a headline on his note, Wall Street ominously trading 07-08 analog. Asset performance in 26 is more ominously close to price action seen from mid-07 to mid-08. Oil peaked July 3rd of 08, the same day as the ECB hiked, one of the great policy mistakes of all time. 74 days later, Lehman bust, global financial crisis in full effect as credit trumped oil. then he finishes with this ominous sort of trading pattern, the analog back to 07, 08. I don't know if you want to take a stab at that in the context of how you view what we're witnessing within the markets today.
Well, fortunately, I don't, because I read the note, and I think that there's similarities that we can find in any disruption. So when you have a geopolitical event like we're seeing in the Middle East, it's easy to make these comparisons. I don't think the backdrop is the same, but I think Jimmy's point is the most important, which is if we can resolve this more quickly, that's going to be a much more appropriate runway for the stock market to recover.
Now, does that seem like it's going to, like, what are, you guys play probabilities, right? I mean, that's what this whole game's about. It's the probabilities, not the ifs. So there are a lot of ifs. Like if you're saying, well, if this can get resolved quickly, does it seem like it's going to be?
So it's so easy to play political science expert. I'm not. I'm a stock person. So I can look at it and say, I hope that it gets resolved. I don't know. But to the point of earnings, we're looking at double-digit earnings expectation for 2026. If this oil price stays higher, it affects not just the consumer, but margins, corporations, and ultimately earnings, which is why you said 1 to 2 quarters of guidance. If this gets resolved over the next 2 weeks, I think we can put it in the rearview mirror. If it doesn't, I think we'll need to worry about it. I don't know what the odds are.
You know, it's not only about probability, definitely about probability, but it's also what's the risk? Do I have greater risk to the downside or do I have greater risk to the upside, depending upon which I determine? So your probability weight that.
Gosh, I don't know how you can answer that with any pure level of conviction.
And that's the point. And that's exactly the point.
Because a headline about Hormuz or a movement in oil, that's positive. You're probably going to have a rally rip like you haven't seen.
Which is why you can't be short. Yeah, which is why you can't be short.
Which is why the battle right now is between getting more bearish and what some have called the so-called Trump put. Citi today says investor positioning is becoming more bearish, converging towards levels seen during previous conflicts. However, the de-risking is not yet at extreme levels, suggesting a measured response rather than widespread risk-off positioning. Barclays says investors still believe in the Trump put. Hence, global equities are not down as much as in past oil shocks. Obviously, nervousness is growing by the day, and the longer the strait stays closed, the more stagflationary markets will turn. But that's the battle, Bryn, right? The battle between growing more bearish and the so-called Trump put, among other things.
Well, we may agree with the Trump put, but do the Iranians. So, I mean, ultimately, China has to step in, what have you. So this is, to me, like the Trump put, I think, is there. We're in the midterms. It already looks like the Republicans are going to lose a lot of seats. We have inflation going higher. And so if you just think about it from a put perspective, we can't have a prolonged war for a bunch of different reasons. But the most important one is just like the U.S. economy does not have the tolerance for that. We need to have oil prices come down and not get embedded in the economy. And so I think the Trump put is there, but I do like to balance myself. Do the Iranians care about that? And to me, when it's like existential, their survival from a leadership perspective, I think that adds just like a wrinkle that's very hard to map out how this actually ends and what does that end actually look like.
That's true, right?
Yeah.
Although, I mean, let's be honest. You know, what is a perhaps fair amount of resistance today by the Iranians may not be tomorrow. We'll have to see how this all plays out. Amid other reports that we've got more apparatus, both human and technological and physical, heading to that region.
Yeah, and if you do put boots on the ground, that extends the conflict. That extends the worry in the market. That extends the concerns of forever war, which I don't think is ever going to be on the table, forever war. But, you've got the backdrop then going to Michael Hartnett's note, which I disagree with. This is nothing like 07, 08. But there is an issue. There are headline risks. And by that, I mean that why it's not 07, 08, because the banks are much better now, much better risk managers. They don't have those issues.
I think he's just looking at some of the trading patterns.
Right.
I don't think he's saying that this is another 08.
Yeah.
He's just looking at the way that, oil had moved, how central banks had reacted. We do have meetings next week. from not only ours, but European, the ECB. So he's just looking at the way that certain things have traded and different fallouts that have happened. He is not, I don't believe, suggesting we are in another pre-08 crisis position of that magnitude.
Right, but a lot of people read it and they see 07, 08, and that's the biggest fear. But what I'd say is that the headline risk is not just with the straight. The headline risk is when all these funds stop allowing redemptions. Now, you fund redemption. What these let's just do trading 101 here. You invest in a private credit fund. They then allocate that to loans. So theoretically, all their capital should be in loans, which are illiquid instruments. So when a redemption comes, they borrow money from a bank. Hedge funds, that's what we do. If somebody wants to take some money out, we're in positions. We're not selling, we're buying, we're borrowing until we're ready to sell. So the banks are not giving out that credit. So the headline risk is BlackRock. I'm not saying they'll do it, they won't do it, very well capitalized. But a big name, a brand name like that says no more redemption private credit, then that's when things get really, really ugly.
Well, there is a view as well that the actual fundamentals of private credit are perhaps better than meets the eye, better than what the overall narrative may suggest. Until they're not. Well, of course, with some exceptions. Yeah. No doubt, but there are always some.
No, but I mean, but there are so many private credit funds out there that it's just lunacy. When I say some, I'm comfortable with the big ones. I'm comfortable with the big firms because they have very, very mature risk management. But you've got so many. How many emails do we all get? Let me fund your business, today. So lots have done that. It's ubiquitous. That's the danger.
Let's bring in Leslie Picker. She's following this story every day for us and for good reason, staying ahead of it. There's no question about that. So what do we need to know today, Leslie?
So actually, Scott, we are seeing a bit of a rebound in alternative asset manager stocks today. Ares and Blackstone, well, they're leading the way. Those shares up about 4% each. But the majority have lost about a fifth of their value as, yes, you guys were just talking about it, investors have been yanking their capital out, or at least trying to, from some of the biggest semi-liquid private credit funds. Now, perhaps some of this optimism this morning stems from a new report from B of A, which showed that amid a survey of 50 independent financial advisors in March, so pretty recent, 40% said they have seen increased client demand for private credit. Well, 48% have seen no change in demand over the last 12 months. Now, this is somewhat surprising given the surge in redemptions that we have seen as of late. And I think the disconnect can be attributed to the opacity of the fundamentals. As you mentioned, Scott, defaults are rising among private credit borrowers, but they're still below crisis levels. JP Morgan revalued its collateral this week based on software, but it didn't take any losses. There weren't any margin calls. It was just a slight revaluation there. Now, one thing to keep an eye on are these so-called payment-in-kind loans, which are what borrowers pay interest by taking on more debt. That has been rising across private credit portfolios. So this implies there could be a bit more stress under the surface, but that can is getting kicked down the road. So I think there's just this disconnect, Scott, of what's really happening across these portfolios. Are the headline fundamentals believable? Are they something that can be trusted? And that's why you see just this gap between, maybe the sell-off in the public markets versus the redemptions versus, a survey like this B of A one, which shows that people are still allocating to the space.
Well, I mean, headlines, narratives, and fear are a pretty significant brew.
Yes.
That can obviously cause more concern than maybe there. This is going to play out. And we'll see again soon. I know that because there's going to be more to report. We appreciate you, Les. Thank you.
Thank you.
Leslie Picker. So, Bryn, you have been investing in some of the Blue Owl BDCs, or maybe one, maybe more. What's your take at this point on where your concern level is, which, if I recall, hasn't been to a boiling point yet where it's been over the pot, but maybe it's starting to rise in temperature? You tell me.
So, I keep adding to OTF, right, which is Blue Owl's tech fund. I know the team, I actually know the loans. They disclose the loans every single quarter. They actually have a small equity position in SpaceX. And I think you summed it up very well, and so did Leslie, is that are the fears overblown? Here's a good stat. Over the last 10 years, The top decile private credit manager did 12%. The bottom decile did 4%. And so to me, what's been a bit frustrating is just this private credit is bad. Well, when you have an 800 basis point per year spread between the top and the bottom, this is the time where I think you got to separate the wheat from the chaff. And I think that the managers, we will see your track record is what it says it is over the next year and a half or two. The managers that did good underwriting come out on the other side, I think will be big winners, and the ones that don't. I do think for private investors, though, one of the reasons investors have gone to private credit is although over the last 10 years, the top decile fixed income manager did 2%. And so there's just still a big disconnect in terms of returns and also underwriting standards. And so that's really what I'm focused on. I feel really good about the team at Blue Owl and the tech fund and how they underwrite. And I feel like this shouldn't be an $11.69 stock.
The financials have had a really tough go of it. Third straight down week. It's the first time that we have seen that since last fall, since October. Enough that UBS has now adjusted its model credit portfolio, shifting our financials trade from a long-short basket to a more explicit short position, targeting financial institutions with greater exposure to private credit risks. They're, obviously the private equity and credit firms. The financials, Jim, you have exposure in both areas.
Yeah, I'll take the other side of the trade. This is what makes a market. Frankly, I think the decline that we've seen across the sector over the last several weeks is healthy. I think it's a reset. If one has a base disposition that we're going into a recession, then yes, financials are not your call. I understand, we all understand, we just talked about what's going on in the Middle East, but we have to understand that beyond that, the economy is in very good shape. Whether we're looking at jobless claims, GDP, CapEx, and there's a lot of reasons to expect that it can power through what's going on in the Middle East. And as I've just said, I think all you're seeing here is a valuation reset in the big names, whether it's money centers like Citigroup, whether it's asset managers like BlackRock, whether it's private markets companies like Apollo, and that from this reset with a strong economy, you're likely to see good returns.
It's been tough sledding for a lot of cyclical areas of the market, not just the financials. Industrials, discretionary 6 negative week in 7. Materials worst month since December of 24. Industrials worst day since April 25. And Kevin Simpson has bought more Caterpillar. Tell me more.
I bought more Caterpillar yesterday, Scott.
Okay.
685. This is a stock that we had sold because it was called away maybe a month and a half ago. And to Bryn's point, covered call writing in a volatile market is a phenomenal way to add alpha to your portfolio. But I like what you said, Steve, that it's not a tradable market. And I agree with that, but I think it is an investable market. So for us, we're looking at this not as a trade, not as an idea that the stock can't go lower, and if this conflict drags out, I expect that it will. But we're accumulating a position in Caterpillar, have been doing so for 2 weeks. At 685 yesterday, I feel like it was a great buy. I still have dry powder. If it's cheaper next week, Scott, I'll add another 1% to it.
What do you think about that, Weiss? Do you own it too?
I do own it. I haven't sold any of it. No, I think that's absolutely right. It's an investable market where you're not prisoner to a time frame, right, where you have to exit like you would be with a trade, right? Because you don't take so much pain. So I like it with Cat. Look, Cat had gotten overvalued. I had thought that it would grow into the valuation.
Stock was like straight up to the right. Look at it. Up until the pullback that we've seen more into later February.
Right, and I'll tell you why I didn't sell it. I didn't sell it because it didn't get like Taiwan Semi, which is still my largest position. I sold that because the position just got unmanageable. It was so big. Cat was not at that position yet. So I think Cat, and I didn't sell it because I didn't want to pay taxes. I believed it would grow into the valuation at some point. So now I've got room to add a little. However, I'm just not adding to it because this is not going to be a 10-year hold for me. All right. Microsoft will be, this won't be.
Hey, let's talk about software, which has had a nice rebound lately. Month to date, a lot of the names that have gotten crushed year to date have actually had a nice rebound. CrowdStrike, Palantir, Oracle, Snowflake, among the names I'm talking about. Morgan Stanley today puts out a note they call a rallying cry for software coming out of the TMT conference. Remember, Morgan Stanley had its TMT conference in the last couple of weeks out in San Francisco. They feel better, they say, about the defensibility of our intra-software coverage in regards to AI risks. It leads me back to Kev. You bought Intuit and you bought Palo Alto.
Yeah, in our growth portfolio, we were terribly light in software, Scott, so we lucked out when it rolled over. But literally in our trade meetings, our team was like, how much lower can it go? And Intuit is one where I don't think that there is disintermediation. I think, if anything, it's an adoption of LLM to bring them into the fold, make them more efficient. TurboTax, QuickBooks, Klarna. It's not just a retail stock. It's also a small business, I think, ecosystem that you're using this business software for years and years, decades and decades. You're probably not going to leave it. So we didn't think the stock was going to get much cheaper. We picked it up at $400. We're up 10% on it, and I think it's going to go higher.
Palo Alto?
Palo Alto is a trade where I think all of the cybersecurity kind of sold off on earnings.
Yeah.
I don't know if it was guidance related or what have you, but with more AI, I think you need more cybersecurity. That's kind of basic. But since the Iran conflict started, these stocks have really been on a tear. We like Palo Alto a lot. I can go through all the numbers. I'm not sure if we want to get bored.
But I think, the stock sold off in part as, Anthropic and its Claude was introducing these new tools. It was just another area of disruption fear.
But I don't think it was justified. I think there's going to be haves and have-nots. I think that the cybersecurity is going to benefit from a lot of this. So much so that they went in February, and I think they bought like $6 billion of their own shares late February. So I like that. We're investing alongside them.
All right, so then there's Adobe. Let's take a look at shares. They have their earnings report. The stock is down 6%. It's not that the earnings were bad, record revenue, EPS beat. It's that the CEO, Shantanu Narayan, is going to step down after a successor has been appointed. He's going to stay as chair, but it is a big move from a very distinguished figure in the software industry. 15 price target cuts, at least, following their earnings, many citing Mr. Narayan's departure, in which Barclays does as well. They downgraded to equal weight from overweight. They say his leadership has been exemplary, but we think it will take time for a new CEO to effect change here. There were already questions about what was happening with this business relative to the AI disruption. Jim Lebenthal, we've talked about this on so many occasions, but we have to now because you still remain in the name. Shantanu is leaving as CEO, and lo and behold, you're buying more.
Just in my personal account, this is not something I need to get into an argument or a discussion with all of my clients about why we're adding to it. But the reason to add to it is basically I think the fears are overblown. I said yesterday in premonition of this that the results were likely to be good. They were, as was the guidance, but that it wasn't likely enough to put the bear case to bed. And that's the case as we're seeing here. Certainly the CEO's departure is not something that I'm really happy about. However, it gives me the price action with which to add to it. I want to point out that the sales growth continues to be just a little bit above 10% for a company that has a price to earnings multiple of around 11. And more importantly than that, as they continue to grow sales and earnings, they're growing free cash flow. Free cash flow yield right now is 11%. And what they're doing with that free cash flow is buying back shares. They've retired 10% of the shares outstanding in just 2 years. They're going to continue doing that. So if the bear thesis, which is that AI is going to crush their business, comes to pass, or rather doesn't come to pass, the net income is going to continue to grow on a much smaller share count, and I'm going to make out fine. In summary, I've done this many times before, of buy companies that are down, buying back their shares like crazy. Whether it's Citigroup, it's General Motors, it's worked out. It usually feels lousy at a time like this. I'm not expecting anybody to pat me on the back, but that's what I'm doing.
Well, you don't know General Motors anymore, and I think it was the day one of the tariff news that you sold it.
Yeah, it went down from there, it went back up, but I made good money on it. And both General Motors and Citigroup put in accelerated share repurchases, which shrunk their share count meaningfully, and I'm seeing the same thing, not an accelerated share repurchase here, but an effective decline of magnitude.
You don't feel like you're on a subway car to nowhere here?
Look, listen.
Did you get that?
No, I got it. Of course, anybody who's invested in a stock that goes down like this feels a sense of doubt. Of course. It'd be foolish. Can I finish my thought before? Okay.
I'm not going to be able to stop you.
Go ahead, please.
Yeah.
Go ahead.
Of course, it would be foolish to think that you know everything about the future. Investing for the long run is making decisions, as you said, Scott, about the probabilities. The probabilities, I feel, are that this is going to work out. But right now, I know it doesn't look like that.
Well, it's about risk management, too.
Yeah.
Which, honestly, I find it interesting that you don't feel you can defend this to your clients but you can defend it. You own it personally.
Yeah, and I'm not saying that I won't own it for clients, but one of the things I've known with my client base is they usually like to see the stock establish an uptrend. I think we can all agree that is not the case here. However, for me personally, I see the value here, and I'm investing personally in it.
Without the stock buyback, right? What's earnings growth?
Around 10%.
Without the stock buyback,
exactly
they bought
right.
back 10% of their shares.
Yeah.
So you're saying, so you're telling me that it would have been 20% then?
No, that's not the math, but the net income year over year was up about 12%, Steve.
Okay, and the stock buyback has no impact on that.
No, of course the stock buyback has
That's
an
my
impact.
point.
Yeah.
So on the same share count base
Right.
a year ago,
Right.
the earnings growth would have been a lot less, right?
No, net income, not earnings per share, was up 12%.
I'm talking about earnings per share.
I'm talking about net income.
Well, but my question was on earnings per share.
Okay, your question was what was net income growth and how would that have, what's
It
your
doesn't
point?
matter.
What's
It
your
doesn't
point?
matter. The
What's your
point is that their growth is based on financial engineering, and the growth of the company has significantly declined. Cost had to have gone up. I'm not looking at an income statement at all. But I would tell you that, Jim, I remember you coming on saying, look, they got one more quarter. You said this for the last few quarters. One more quarter, if they don't produce, then I'm out. And here, you're going to say, well, they did produce. They beat their reduced guidance, but the CEO left. So you're buying the stock without even knowing who the new CEO is. So
Right.
what if
Well,
they bring
Steve,
somebody you completely
Steve,
disagree
Steve,
with? Let me finish
calm
as you
down.
finish.
Just
Let me
calm
finish as
down.
you finish.
Okay, but lower your tone.
Jimmy, there's no need for that, okay?
No, you're
okay. There's no need for that. I'm talking to you.
Okay.
So my point is,
You're
that
talking to me with a tone that I'm not sure I'm going to respond to.
Okay, I'm sorry. Sorry, I'm not condescending like you. So you said you would sell each of the last 3 quarters. You haven't, yet you're buying more.
Yeah.
So explain that inconsistency.
Yeah, well, I don't see it's an inconsistency. What I see is that the operational results of the company are frankly quite good, and the share price has gotten cheaper, and so I'm willing to step in from that.
All right. We'll see how it develops from here. Okay? Maybe we'll have this conversation some other time. We're going to take a break. We'll come back. NVIDIA has a big event next week. In case you didn't know, it's the GTC, and it's significant. Christina Partsinevelos is going to join us after the break with exactly what we should expect, what might move the stock from here, where we do have a move from somebody on this desk as well. We're back after this. right, GTC, that is NVIDIA's big event. It is Monday, and it comes at an especially important time for this stock. Christina Partsinevelos joins us now with what's at stake for a name that didn't trade well after earnings, had a nice little move after that, but now obviously all bets seem to be off just considering what the narrative is around the market.
Yeah, to your point, shares just have been stuck despite hyperscalers. Also, you talked about strong earnings, but hyperscalers pledging to grow AI spending through 2027, and NVIDIA's order backlog topping $500 billion. Scott, the really question isn't about demand. It's the pace of that demand actually hitting the income statement beyond 2026, beyond 2027. At the conference, CEO Jensen Huang is expected to unveil a new chip using technology from Grok. This is a startup NVIDIA acquired for roughly $20 billion. And unlike most AI chips which rely on external memory, high bandwidth memory, Grok's design puts memory directly on the chip, making it more efficient for inference, the part of AI where the model actually responds to you in real time. I expect details also about NVIDIA's push into high-speed optical networking using light to link thousands of chips together. NVIDIA recently called themselves the, quote, largest networking company in the world. There's also a potential joint announcement with Intel on custom CPUs for enterprise data centers. And then CEO Jensen Huang said we're expecting to detail NemoClaw, which is NVIDIA's new platform for AI agents. The move puts NVIDIA deeper into software, potentially competing with the same cloud and enterprise partners it relies on for hardware sales. And I have rumors that there's going to be stuffed lobsters being available and a lobster playground at this event. The options market is pricing in roughly a 4% move, which is kind of modest by NVIDIA's standards. Last year was roughly 6% at GTC, with rivals Broadcom and Marvell already guiding through 2027. NVIDIA sticks to quarterly guides, so any forward visibility from NVIDIA could be the real catalyst here for this stock.
Okay, interesting. Christina, thank you. Christina Partsinevelos. So NVIDIA target goes to 215 at Daiwa. It's right ahead of GTC. Everybody's sort of thinking about this. Rothschild and Redburn says unless oil goes to 150 and sucks the air out of the room, NVIDIA will likely be the market's primary focus next week. Ordinarily, it undoubtedly would be, but now you have so much other stuff going on that we'll see what happens. Bryn, you own the name. Do you have high optimism coming before this event?
Well, I mean, this event every year is incredible. The last 2 quarters were incredible, but I continue to sell calls with a strike price of 200 because the stock just can't get above there. But I do think we're going to hear a lot about Vera Rubin, the new chip, which is apparently 5 times as fast. And as Christina was talking about the light to connect that, right now they use copper. And so I think that's going to be really interesting. Let's see if copper gets any movement off that. And so I think it's going to be a great event. We're going to see a lot about robotics. What's awesome as an investor is this event lets us see what is the future of AI going to look like. And they always have companies they partner with and show off on stage. So I think it's going to be a great show, but I don't think the stock can get over 200 anytime soon.
I don't know, Kev, you bought more coming into the event.
We did. We bought this in advance of the event specifically for what we expect to see. It's almost like this stock has been pushed to the back burner. And for that reason, we've made this our #1 position in our new growth strategy. It's a 10% allocation. We're very excited. If it goes to 200, Bryn, that'll be awesome. From 180, I think you can write calls against it. But quick back of a napkin, I know this oversimplifies it, but just imagine if they make $10 a share. And you put what multiple on it? 21, 25, $210 to $250 is really our base case. So I like it here. I think it's going to be a great week. And we're looking at this again, not as a trade, Scott, but as a long-term.
We got to hit Meta real quick, too, because stock is down, I think, like 3% plus on some negative news from the New York Times. There it is. I think the stock's the worst in the mega cap group today. They delay their rollout of their new AI model after performance concerns. That's according to, again, to the Times. Performance falling short of Google, OpenAI, Anthropic. What do you think about this? You own the stock.
Yeah, so,
are you concerned about this?
I'm not, because this is just typical in the tech world now. It's a heightened tape in terms of the volatility. But look, it's a timing difference. We see timing differences all the time in technology, particularly with AI. They're just very, very difficult to perfect. So rather than launch a product, and we saw that with Gemini a couple of years ago, that didn't work out so well and set them back, Meta's choosing not to do that. So I'm actually fine with it. It's a full position with me. If it were, I was just talking to Kevin about adding more. If it weren't full, I would add right here.
All right. Frank Holland has our CNBC News update.
Hey, good afternoon, Scott. CENTCOM confirmed today that all 6 members of a military refueling plane are confirmed dead after their plane crashed in Iraq while taking part in Iran war operations. Earlier today, military officials said rescue operations were still underway for 2 of those service members. The Pentagon said the incident was not the result of enemy or friendly fire, but the circumstances of this crash are still under investigation. The Teamsters Union is urging the Department of Justice to block Paramount's takeover of Warner Brothers Discovery, the union submitting a report to antitrust officials outlining their concerns about the deal. The Teamsters claim the merger will consolidate power and eliminate jobs. And Amazon is reportedly planning to move Prime Day to June from July. The summer version typically coincides with back-to-school shopping. Bloomberg reports the shift would also move sales to Amazon's second quarter. Amazon has had to contend with competing events from Walmart and Target, who are investing in their online business and same-day delivery. Scott, it'd be a perfect time to get you an Eagles jersey, a Phillies hat. Phillies, by the way, number 6 on the MLB valuations. I'm just trying to help you out.
Yeah, never. They're never going to happen, Frank. Thank you. Appreciate the suggestion, Frank Holland. All right, coming up, counting down to the Fed. A big meeting next week. So how now does the war impact the central bank's decision? We discuss with Steve Leisman coming up. All right, welcome back. At the Fed meeting, of course, next week. What will this war now mean for the central bank's decision? Let's bring in our senior economics correspondent, Steve Leisman. Nothing was obviously expected to happen, really, at this meeting. Does the war in any way change that, Steve?
It could change some of the outlook, some of the forecasts that we get. I think that the Fed's going to feel like it's in a pretty good place and kind of thankful that it paused at the last meeting, Scott, because if you think about it, they're a little bit above neutral right now, or where most people believe neutral is. And they wouldn't mind going into this oil price spike being a little bit above neutral to put whatever pressure would come from inflation and the headline
into the core. You do have some sneaky or sticky service inflation that's going to get the Fed's attention. So I would look, Scott, I think what they're going to probably do is raise maybe the long run outlook could go up a little bit, but certainly the expectations for inflation might rise a bit here too.
Do they typically take a more wait and see approach at times like this, especially given the unknown of where oil prices are ultimately going to go potentially and for how long they may stay there?
I think when it's unclear, you remember the old Tom Barkin concept, which was, in the fog you pull over? I think that's where the Fed might be. If there was something very obvious, for example, monthly declines or substantial declines in the job market, the Fed would probably respond to that almost irrespective of oil being higher. If there were a continued pressure on inflation, then the Fed would probably be hiking here. What you're looking at there are the probabilities. We put back a little bit after today's data, some probability of a single cut this year, but that was all the way down to, I think it was below 50% yesterday, Scott, or just a little bit above it maybe. But bottom line is we've already priced out, 2 cuts already, and we're trying to hold on to 1 cut here. And the question becomes, will Kevin Warsh abide that, or does he try to basically corral the committee toward an idea that he thinks they ought to be cutting?
It will likely, get continued dissent, at least one. You would think, just because that's been the norm from the obvious areas at the table. Steve, thanks. We'll discuss more in the days ahead. I know that. That's Steve Leisman. Coming up, playing the pullback in the home builders. The ITB now pacing for its worst month since 2024, and man, mortgage rates just hit a level that Diana Olick's going to give you the number next. Welcome back. You know, yields have been rising since the start of the war, and that means that mortgage rates have too, right, Diana Olick?
That is right, Scott. As you said, mortgage rates have been rising all week, but today the average rate on the 30-year fix just popped up to 6.41%, according to Mortgage News Daily. That is the highest level since September 4th of last year. And remember, we just touched 5.99% just a few weeks ago. We are now approaching where we were last year, and last spring's housing market was not exactly stellar. Now, homebuilder stocks had been moving higher today with the broader market, despite a big miss from Lennar in its Q1 earnings. Lennar's chairman, Stuart Miller, said in a release that Q1 was defined by persistent headwinds, that is, high rates, constrained affordability, and cautious consumer sentiment, plus geopolitical uncertainty. So, Scott, it's going to be a rough run for the builders.
It is interesting, though, that Lennar's up. Di, why do you think that is?
I mean, look, their margins shrunk because they said that they're trying to get as many concessions in to get buyers into the door. And, you know, they had that optimistic outlook that they are going to see more from the spring market. But again, you're seeing these constraints with mortgage rates. And if you see them move higher and higher and higher, it's going to be hard for them to get those buyers in the door unless they continue to buy down mortgage rates, which they have been doing. But again, like I said, it hits their margins.
Yeah, no doubt. Appreciate your insights. Thank you, Diana Olick. Jimmy, I mean, housing can't catch a break.
It really can't.
And not catch a break.
And look, we're seeing upward pressure on the Treasury yield curve, so this is unfortunately to be expected. But none of this goes to really help the supply issue, which is facing the nation. I don't know how that gets solved in any short time frame. I mean, I look at stocks like Home Depot and I want to get into it, but I just can't.
Down 13%,
based on the fundamentals.
Down 13% in a month is Depot. Kevin owns that. But the home construction ETF, the ITB, 4 straight down weeks. Worst month it is tracking for now since December of 24. You got Depot.
I'm fine with Home Depot, and if you're not going to buy it yet, I wouldn't, twist your arm on that one. But I think that when we look at some of these other names, from a teaching moment, I'll just give you top build real quick, because this is one, Scott, we got stopped out of it yesterday at 360.
Down 34% in a month.
Luckily, we only lost 10%. We bought it at 400. It ran to 550, and in a month, it went from 550 to 360. So what would have been, could have been. But for us, we took a 10% loss. We can live to fight another day. But there will be opportunities here. We need the 30-year. We need the mortgage rate to get below 6%.
They're the ugliest charts I think there are of any group. I mean, it's just crazy.
All right, take a break. We come back. We'll do the setup next. Some key earnings to discuss and to trade, and we will do that after this break. All right, welcome back. The setup, Micron, okay, is Wednesday after the bell. Let's throw up the chart. It's up 47% year to date. So let's look at that, not the intraday. If you guys mind throwing that up, please. The stock has been a killer. I mean, it's also like, I don't know, 6 months. Stock's been crazy, right? Along with a lot of these memory names.
The 6-month chart is insane. Insane.
Let's look at that.
If they don't nail the number, I mean, it could be a sell the news event, but the street's looking for $8.69 in EPS and a massive year-over-year growth. So this is the AI infrastructure story. We know at some point DRAM is cyclical. We're not close to the end of it, so I'm excited for this one.
You don't get nervous going in with a chart that looks like that?
I'm always nervous.
Yeah, I know, but you know what I mean. Like these memory names, all of them the charts all look the same.
Well, that's why I'm saying it could be a sell the news event if they don't nail it. But no, I think the expectations are going to be met and surpassed. We'll have to look at the whisper number, but this I can't believe I'm saying it.
I don't even know if
It's
there's a
just
whisper
not
number
over.
anymore. It's a screaming number.
Yeah, you're right.
It needs to be good. All right, we'll take a break. We'll come back. We'll do finals after that. All right, we'll wrap the week up on Closing Bell with Glenn Kacher, Stephanie Link, Stephanie Aliaga, Warren Pies, Michael Ozanian. He's got his new MLB valuations, and we will go through that. We'll see how this week ends. Another volatile one at that. Bryn Talkington, your final trade, please.
GPIQ targets a 10.5 distribution yield, sell calls on the NASDAQ, good equity income play.
Thank you very much. Farmer Jim.
Citigroup, we talked about the financials earlier, and who knows how the economy will go, but the Banamex IPO coming up should unlock the balance sheet at Citigroup.
Okay, NVIDIA is Kevin Simpson.
We added to this in advance of GTC. The street looked at the earnings with a yawn. We're making this a core position for 2027 and beyond.
All righty, thank you. Stephen Weiss.
Meta, I mean, I think your downside risk is probably 600, but more than likely it's going to bounce.
All right, good stuff. Thanks, everybody. I'll see you on the bell. The exchange is now.
And thank you very much, Scott. We're keeping a close eye on oil again today while the broader markets look to be on hold into the weekend. Welcome to the exchange. I'm Kelly Evans, and we have WTI crude nearing $97 a barrel as the U.S. is reportedly moving more warships to the Middle East. 100, you could call it, back in sight again as we head into the weekend. The level of Brent is around 102. Stocks are responding in kind, unable to hold on to their earlier gains. All three major averages are now on track to end the week lower by 1% or more, nearly a 2% drop since Monday for the Dow. Financials and industrials down 3%. Those are your worst performing sectors, and 4.28% on the 10-year Treasury yield. Again, we were below 4% just a few weeks ago. It's going to have an impact on mortgage prices and the rest. But let's begin with the latest developments over in the Gulf. Secretary of Defense Pete Hegseth saying there's no need to worry about the Strait of Hormuz in a morning briefing. 2 hours ago, we got reports that the Pentagon plans to send additional warships and Marines to the region. Let's get over to Eamon Javers for the latest. Eamon?
Kelly, that's right. The Wall Street Journal reports that the Pentagon is moving a Marine Expeditionary Unit to the Middle East as the Strait of Hormuz remains closed to international traffic by the threat of Iranian missiles. Now, the Journal is citing 2 U.S. officials for that report. These units generally consist of about 2,500 Marines. Defense Secretary Pete Hegseth did not mention that at the Pentagon briefing this morning, but he said today that the administration has been dealing with the Strait of Hormuz and there's, quote, no need to worry about it at the Pentagon press briefing this morning. He also suggested, but didn't provide any details, that the U.S. military has options to get traffic flowing through the strait again.
So we have a plan for every option here. We're working with our interagency partners, and that's not a strait we're going to allow to remain contested or with a lack of flow of commercial goods.
Hegseth also said that the quantity of Iranian missile fire has been drastically reduced in recent days, and he called into question the physical status of Iran's new supreme leader.
We know the new so-called not-so-supreme leader is wounded and likely disfigured. He put out a statement yesterday, a weak one, actually, but there was no voice and there was no video.
Hegseth also responded to leaks that appeared in Politico this morning, suggesting that Vice President Vance privately opposes the U.S. war in Iran and is skeptical of the chances for military success. Hegseth called Vance an indispensable voice in the administration. Separately now, U.S. Central Command has sadly said this morning that all 6 crew members aboard a U.S. KC-135 refueling aircraft that went down in western Iraq are now confirmed deceased. Kelly, back over to you.
And Eamon, as we head into the weekend, are you getting any more sense from the administration? You know, I've heard reports that say things like, you know, Trump's patience is wearing thin, but every time he posts publicly or talks about the topic, he seems to be digging in his heels.
Yeah, I mean, the president's been saying 2 different things simultaneously throughout the week, right? I mean, one is that we are there indefinitely. We have plenty of ammunition, plenty of time, he has suggested on social media, to do this. But in other commentary, he has said, you know, this is a short-term operation. It's all but complete. We've basically won the war. So, you know, 2 entirely separate messages coming from the president at the same time, clearly trying to win over 2 audiences. One is those who are concerned that we'll get out of this too quickly without any tangible, complete results. And the other is that we won't end it quickly enough and will do damage to the global economy.
Yeah, it was an interesting piece in the Journal yesterday, the day before, and I think it was Barton Swain, but his point was no one can quite understand kind of the strategy for the president here other than the fact that perhaps he's frustrated that the U.S., quote unquote, doesn't win wars anymore. And he's talked about that. And so as people try to game out what the pressure point is on him, is it the stock market? Is it the midterms? Is it, people in his own party? Is it a legacy thing now? Is it a long-standing sense that he just isn't pleased with the way that we've handled conflicts? And now the stakes for him, obviously, to find some resolution to this one are really high in his own judgment.
Yeah, I mean, the stakes for him and for all of us, Kelly, are really high. And look, I mean, you talk about frustration, and we saw some of that boiling over in the Pentagon briefing this morning when Defense Secretary Pete Hegseth really attacked the media. He was very concerned about reports that the U.S. had no plan to keep the Strait of Hormuz open before the president launched this war. He said, of course, we anticipated that. Of course, we had a plan, but here we are,
right.
With the strait not open, right? And so they're dealing with a situation that is very much not of their making, but was relatively easily anticipated, according to all the defense experts that we've heard commenting on it this week. So the question is, what are they going to be able to do now with the U.S. military? And does that involve boots on the ground in Iran to secure the Iranian coastline of the Strait of Hormuz? That could be a very complicated operation by the U.S. military.
And not necessarily a quick one, I think, either.
That's right.
Eamon, thanks. Eamon Javers, we appreciate it. With all the focus on what this means for the oil price, let's bring in Pippa Stevens with a closer look at the moves we've seen. Pippa, and what may be coming now?
Hey, Kelly. So oil's up about 1% today. Brent is holding around 101.35 with WTI just shy of 97 as the U.S. Treasury temporarily authorizes the purchase of Russian oil. But a lot of caveats there. It's oil that's already at sea, loaded before March 12th, and the waiver expires on April 11th. Now, JP Morgan noting that oil loaded before the war is still arriving at final destinations. That will be exhausted by the end of this week for Asia-bound shipments and the end of next week for Europe. Now, they estimate that in total, 6.5 million barrels per day of production is now shut in, and they say that that will rise to about 12 million barrels per day by the end of next week. Now, this is very much becoming a refined products story. We talked about the gasoline crack, but take a look at the diesel crack, which, as a reminder, is a measure of the difference in the oil price versus the refined product. It's now at about $70, more than doubling since the start of the year. Meantime, at the pump, diesel is quickly approaching $5, now at $4.89 per gallon. That's up $1.22 since the start of the month. And finally, keep an eye on European natural gas. It's at €50, I should say, per megawatt hour. That is within a range where we could start to see, Kelly, some fuel substitution.
Pippa, appreciate it. And explain one more time. This is my favorite, current AAA fuel price gauge, okay? I know you just said it, but we are at 363. Call today's oil move unchanged. So people this week, as we go into the weekend, again, are going to be looking at this and having it sink in, this reality that price did not reverse lower despite everything going on with the SPR.
That's right. And we've been talking a lot about how total share of energy and gas spending is now lower compared to what it was during prior oil shocks. But you can't get away from the sentiment of what higher gas prices mean. It's probably the most visible consumer touch point around, even more so than grocery prices. You see gas prices absolutely everywhere. And so even if it is, not at an all-time high or close to an all-time high, even adjusted for inflation, it still starts to weigh on consumers. And of course, there is a lag between when we see RBOB rising and then when we see it at the pump. Wholesalers are buying it. If they buy it at a higher price, they have to work through that entire tank before they lower it. So higher prices here to stay.
If they're looking, they should just say there's a ban on advertising gasoline prices. It's just, you don't want you to see it. What is the lag typically? A few people have been asking me about this. If you run a gas station, for instance, the price we're going to pay today, tomorrow, it seems to move almost in line with the headline oil price, even though I don't think it works that quickly in practice.
Yeah, there's a little bit of a lag, probably about 5 to 10 or so days. But again, it does depend on when the distributor is buying that, when they're filling their tank. And also there is the phenomenon, as you know, of how prices go up for like a rocket and then come down